It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. Here are three things that you need to know to kick off your morning. An upbeat forecast boosting shares of memory chip giant Micron. It says sales could be as high as $4.1 billion in the fiscal fourth quarter. According to its CEO, the memory industry has passed its trough in revenue, though the company also warning of continued challenges in China, the world's second biggest economy, which effectively banned Micron in May, accounts for around 10% of its global sales annually. The other potential pain point is the PC market. The company isn't predicting a rapid return to growth this year. And investors are shrugging off the Fed and pushing stocks higher into the quarter end. Despite the central bank remaining in hawkish territory, the Nasdaq 100 headed for its best first half on record. Talk of an imminent earnings recession hasn't dampened appetite for tech just yet. The AI boom still propelling the likes of Nvidia, Microsoft, and Alphabet ever higher. Yesterday, Apple hit another record high and now sits on the cusp, on the precipice of a $3 trillion market valuation. And all clear. The Federal Reserve's annual stress tests of the nation's biggest banks concluded that they're all healthy enough to keep lending, even in the face of a severe economic shock. All 23 lenders tested passed the Fed, and the Fed said recent events highlighted the need for humility when assessing large bank resilience. Now, the collapse of three banks earlier this year, they gave the results an extra significance. The evaluation looks to determine whether they need to hold more capital, and it does so by measuring current buffers against several adverse economic scenarios.
AI, the latest craze on Wall Street, and the hype has significantly helped the stock market's gains this year. Nvidia's stellar 181% surge has been a big contributor to the Nasdaq's rally, and investors are continuing to pour money into chip names of all stripes. AMD recently stole some attention from market leader Nvidia after unveiling its new AI chip with an accelerator that speeds up processing for technology like ChatGPT. But could headwinds derail the chip industry's growth? According to reporting from the Wall Street Journal, the U.S. is considering new restrictions on AI chip shipments to China. This as concerns mount over the possible threat of advanced AI in the hands of U.S. rivals. Shipments to China from chip makers like Nvidia could be blocked by the Commerce Department as early as next month. One chip maker we're looking at today is Micron. Shares jumping in pre-market trading after the company beat Wall Street's estimates and provided an upbeat forecast for its fourth quarter sales. But to be clear here, this is a company that is not as exposed to the AI industry. This is a memory chip maker whose chips go into all manner of devices from PCs to smartphones. It's a bit of a different calculus. So let's get into it. For more on the chip industry and Micron specifically, we're joined by Angelo Zeno, CFRA Research Senior Equity Analyst. Angelo, thanks for being here. So talk to us about where Micron sits in this new revolution, because indeed, this is not Nvidia, right? This is an old school memory chip maker. So how does it stand to gain, if at all, from what's going on with AI?
Yes, so you're absolutely right. I mean, in terms of who we would view as kind of the direct and most the biggest beneficiaries out there from kind of that AI theme, I wouldn't say they're kind of one of our four favorite names out there, but I do think there is a way to play Micron in terms of kind of the AI theme, and that is as you kind of get to more and more advanced, AI-driven servers out there, there is going to be a need for more memory to be kind of thrown into those servers. And a big reason for that is, I mean, we're talking about these supercomputers, these large language models. Obviously, they need a lot more memory, right? So when you start thinking about more of these kind of advanced next generation servers, you're talking about the potential for them to have, 6 to 8 times more DRAM content in there, as much as three times more NAND content. So as far as, where Micron sits here in terms of the AI theme, it is kind of that kind of greater memory theme out there. And clearly they are more DRAM driven, which bodes positively for them. Over 70% of their revenue exposed to DRAM. So that's really where kind of the memory or the Micron tilt to the AI theme is out there. But as far as AI servers right now, still only a low single-digit percentage of total kind of server sales out there. So it's got a long ways to go here off a very low base.
A long way to go at the same time that the recovery in PC demand, as they've continued to have to highlight quarter after quarter, has a long way to recover as well. And what we got in terms of some of the inclination in terms of what they were sharing on timeline, it sounds like early calendar 2024 is when some of that transition or some of that cycle could begin to reemerge. Is that something that you believe the street is latching on to right now?
Yeah, I think so. I mean, listen, I think as far as Micron is concerned and the memory industry is concerned, I mean, I think management actually did a great job in terms of kind of tempering expectations out there. Part of that clearly has to do with some of the China concerns out there, and that is hitting kind of their revenue here over the next quarter or two. But, you know, in addition to that, I mean, they've essentially kind of pushed out any type of ambitious expectations more so into calendar 25. You kind of look at where street expectations now are into profitability. You're looking more into the August quarter of next year. But as far as kind of where that demand and momentum really starts to pick up, it's more so into the first half of calendar 24 and as we progress through calendar 24. But, you know, as far as kind of how investors should be playing the Micron theme, clearly you want to get into the name well before you see that momentum really start to pick up. And we are seeing signs, you know, across the industry, specifically on the smartphone side of things and even on the PC side of things to an extent, where you're getting kind of those OEMs out there starting to take advantage of these lower prices, locking them in, and that is improving visibility across the industry. And what that also does is that, you know, starts to firm up the pricing landscape and thus kind of gives you a trajectory over the next 6 to 8 quarters where you can see an improving pricing landscape.
I want to switch gears here, Angelo, if we could. We've been talking about smartphones. We've been talking about demand for technology. And I want to talk about Apple for just a moment, because the march to $3 trillion in market cap, it's getting ever closer there. The tech giant reached its $1 trillion valuation back on August 2nd of 2018. Just 2 years later, the valuation hit $2 trillion, and investors are now eagerly awaiting to see if it reaches its next milestone here. So it's at 189.35 in pre-market trading. It would have to be at 190.74 in order to reach $3 trillion. Exactly, 190.74, Angelo. Angelo Zeno, CFR Research Senior Equity Analyst, still with us. So Angelo, do you think it's going to get there? How quickly do you think it's going to get there? And, you know, should people be buying into Apple shares right now?
Yeah, I mean, listen, it'll get there. You know, it got close to there, actually, you know, what was it, back in late 2021. And then we actually saw the pullback from nearly 3 trillion all the way back to 2 trillion. And we're kind of now retesting kind of near that 3 trillion level. So I think it's kind of digested a lot of the gains here over the last 2 years in terms of kind of seeing some of that multiple compressed from what we saw kind of during those pandemic kind of, you know, driven years. But that said, you know, we think that, yeah, I mean, this is a name that should eclipse 3 trillion and get well above it, you know, clearly over time. And it's all going to be driven clearly by our free cash flow assumptions of this company. This is a company where we think can generate 1.3 to 1.5 trillion in free cash flow here over the next decade. And all that is going to be utilized towards buybacks. But when you kind of think about the second half of this year, the comparisons get extremely favorable from some of the concerns that they've had to deal with in the second half of last year in terms of the Forex issues, the supply constraints, and what have you. So we do see revenue accelerating in the second half of this year, and we see a number of catalysts on the horizon in calendar 24 as well as calendar 25, and of course the new VR headset and kind of the potential for spatial computing longer term, I think also represents a great opportunity for the company. But ultimately, this is a very safe haven type company out there for investors, no matter what type of macro kind of economy that you're in. So it's a name we continue to like, and a name we continue to tell investors, you know, don't necessarily trade. It's a name you want to be investing in for the long term.
Angelo, I remain skeptical on any type of headset right now until it's proven that it can be successful in market. We've discussed this in the past. So when you think about the free cash flow profile that you're anticipating for Apple, how is it that the company can go into another hardware category now and make sure that their margins are not compromised, that free cash flow that you're baking in for some of this growth as well is not compromised, and that they can retain this $3 trillion market cap, market valuation along the way?
Yeah, listen, I think as far as kind of our assumptions are concerned, there's not much, I think from our end as well as the street side of things in terms of kind of, forecasts out there, whether it be for a car, whether it be for kind of, a mixed reality headset and the adoption of that technology on the spatial computing side of things over the next kind of 5 to 7 years, where again, I don't necessarily think kind of what you're seeing on that screen right now is going to be that, that kind of, final look that Apple is looking for, right? I mean, clearly the kind of the sleeker glasses and what have you, eventually down the road. But, as far as we're concerned, I mean, the free cash flow generation continues to come from, the growing share that we're going to see, we think, on the smartphone side of things, that is kind of emerge into new addressable markets, in areas like India, penetrating into India and other type of markets where they're not as kind of well penetrated in. And, of course, through higher average selling prices as we kind of get foldable phones, among other things out there. And that's really kind of been the key for Apple over the years, and their ability to really kind of sustain that free cash flow and grow the free cash flow. And we can't forget the services side of things as well, right? We actually think services growth will accelerate into the second half of the year, but long term, I think you see a mid to high single digit growth rate on the services side of things, higher margin in nature, about 2x the margin profile of their hardware business. So when you kind of put that all together, that's where we kind of get those free cash flow assumptions and why our conviction level is so strong long term for this company.
Angelo, as always, you make a good case. Even as much as I don't want to think about the type of face tan I would get if I were to wear that headset on the beach and watch a movie during the summer, that is for a future discussion. Angelo, we appreciate the conversation here this morning. Angelo Zeno, CFRA Research Senior Equity Analyst. Thanks so much.
Yep.
So, where does this story go? Our next guest says trends such as demographics and artificial intelligence are impacting present-day returns, not just in the future. So how do you play it? And we're talking about some mega forces now. Joining us now, we've got Gargi Chowdhury, who is the BlackRock Head of iShares Investment Strategy. Gargi, great to have you here in studio with us today.
Wonderful to be here. Thank you.
Don't you feel like when you say mega force, it should like echo mega force, force.
It should be rattling off of the walls in the studio.
Next time, we'll make sure we do that.
Help us define mega force, perhaps, just to set the conversation.
Absolutely. So think about large themes, thematics that are with us today, that is going to stay with us for the medium to long term, that'll define our investment landscape through every part of the market. So it's not just an equity market story. It can be a part of your equity market allocations, your fixed income market allocations, or your private market allocations. And it is going to be pervasive across different sectors, different industries, and as I said, different asset classes. So we're at BlackRock, we are focused on two specific mega forces right now, which, as you pointed out, was AI and demographics and the changing demographics, but there are other ones. If you think about the geopolitical fragmentation that's taking place, if you think about the transition in climate that's taking place. So there are all these broad mega forces that we think are going to impact investors today. They're coming mega soon, as we say in our report, but they'll also be with us for a really long period of time and change the investment landscape.
And we're still trying to get our arms around the AI megaforce because while AI, of course, is not new,
it is not.
Large language models and being used in an effective way are new. And I've really been struck as we've just started to learn about it, about how many different industries are trying to deploy this. So then how do you think about it from an investment perspective? I mean, if everybody is doing AI, just buy everybody.
Right. So, when we look at how investors have been implementing AI in their portfolios, and by the way, to your point, this has been around for a long time, but we did have that transformer technology that is about a few years old that allowed for us to have this generative AI, which is obviously a lot smarter, and it's going to continue to get smarter and enable us to have more human-like smart behavior, if you will. And investors have been navigating that so far in the large cap tech space, right? That makes sense. We've seen the performance, and that's how it's made itself a part of investor portfolios. As we think about, and this is why it's a mega force, as we think about where AI can go over the next 5 months, but really 5-10 years, I don't think this is just a story of semiconductor chips. This is a story of how this can impact healthcare, how this can impact financial services, how this can impact art world. So, just a quick example, and I'm sure we've all used ChatGPT. So that's, very normal to think about, and it's such a hype right now. But I just went for my annual physical, and I was doing a mammogram, and there was basically an option where you could have a breast cancer risk for women determined by AI. And that was in a hospital in New York City. And I obviously said yes, and it gives you a percentage chance of breast cancer, and it's read by AI. So they take your data and they compare it to 10,000 different people that have similar features as mine, or they look at my ultrasound and they compare it to others. I thought that was really cool.
And so that's the first time that was ever offered, presumably, to you.
For me, yeah. I mean, I hadn't been, I guess this was the first time I went this year. It wasn't available last year to me, not by AI. So and this is just one small thing that happened to me 2 days ago, which is why I'm talking about it. But I think the implications are at its nascent stage. So I think this has been huge in, when we talk about semiconductor chips. But I think when we think about the implications on the broad market, just think back to internet in the 1990s, 2000s. It didn't just impact the tech industry. It impacted every industry, but it impacts how we work today. So I think that is why it's a megaforce. And currently, we're telling investors to look at iShares ETF tickers like IRBO, which is allocating to the AI developers and the AI enablers. And that is one way to get access to the entire value chain, as opposed to a specific large cap tech company, which, by the way, has had an immense run. And to Angelo's point earlier, is a great way to have access to quality, cash flowing, profitable companies.
And so for as much focus as there's been around the chips as part of the broader kind of AI or generative AI kind of totem pole or pillars, if you will, it sounds like also kind of that next wave of focus that's really going to be centered around the companies that have the most data as well to index within their own AI players.
And the data processing ability. So when the enablers of AI. So yes, the companies that have the most data and the ability to process that data, all of the cloud companies, if you will. And then the next version of this, so when I hopefully come back to this show in a few years or next year, we'll be talking.
Not wait that long.
We'll talk about all the different sectors, and sometimes, again, this might have to be something that we think about in an active form, all the different sectors that are beneficiaries and that are not beneficiaries. We have to talk about that too. So what areas of the market are not able to embrace AI? Who's coming to it kicking and screaming? And what companies have had the ability to embrace AI and actually the talent that can deploy AI effectively? So I think it's nascent. Again, and we talked about this earlier, are we going to have the same run-up that we've seen since NVIDIA reported earnings in May? I don't know if it's going to have this kind of, the chart might not look like that, but is this something that we're going to talk about for the next 5 years? I think it's going to be very pervasive in our lives.
And it's a good reminder, too, when you talk about that anecdote, like if you're an investor and you're interested in this, you're at the hospital and you get that report, okay, you find out who crunched the data, who's behind it, right? And get the names of these companies and try to figure out what they're doing. Kind of interesting.
Exactly, and then doing so not with one company, but looking at the theme behind it. And I always tell my friends this, like, if you like a particular idea in the market, like electric vehicles, instead of buying one stock, buy that thematic. So in this case, the AI enablers and developers as a thematic, so going up and down the value chain of all the different types of companies that currently we think are in the space that can benefit the most, as opposed to playing it in a very narrow way, which, by the way, has worked brilliantly, but I think there's more scope.
Yeah, especially as this goes on. All right, markets looking up. Tech stock value We've been talking about it sky high, but earnings not so fast. Analysts predicting the second quarter is going to see earnings drop 6.4%. That's according to data from FactSet. This as the stock price of S&P 500 companies continues to soar, hinting at a disconnect perhaps between valuations and the actual worth of the market's leading companies. We're bringing back Gargi Chaudhry, BlackRock's head of iShares investment strategy. I always struggle with the earnings outlook. I have to admit, Gargi, because it tends to be wrong, the big picture, right? The last few quarters, we've predicted declines, and the declines have been much smaller than anticipated. So what's going to happen this time around, and what does it tell us about valuation?
Yeah, so I think especially the last quarter, I think that's one of the big reasons that we have seen such a rise in the markets. There's such a almost unloved rally, if you will. Especially when you think about how people were positioned coming into the year. And we spend a lot of time looking at sentiment and positioning and flows. And certainly investors weren't, sort of as an overweight equities as they wanted to be. Now, we had that big surprise last quarter. This quarter, again, I'll tell you what we're looking at as it pertains to earnings data. But to your point, it's hard to know. What I will say is that, and this is why we remain a little bit more cautious in our stance, I think that we haven't seen the full impact of the 500 basis points of rate rises that we've gotten so far. I think that's yet to come in the markets across industries. I think it's yet to come across companies when they're talking about their or viewing their profitability. And then if we think that we might get even 2 more rate hikes after this, which is kind of what the market is at this point expecting. Again, monetary policy works with a lag. So is this the quarter where we have a massive undershoot based on what the analyst expectations are? Maybe, maybe not. But is there a quarter, like if that's Q3 or Q4, where we are going to see that slow down? I think so. I think there's been enough data points that have shown us that this economy is very resilient. Absolutely. No doubt about that. I was certainly in the recession camp myself for 2023, and that hasn't been right. But I do think that as we look into 2024, and I don't want to speak too much about this quarter in terms of it being stronger or weaker, but I do think as we look further out, I think there will be that impact of profitability, of margin resiliency as it pertains to still high inflation and high rates and labor markets being very, very tight, and the impact that will have on companies' profitability.
We've already seen a few levers that companies have needed to pull, even in advance of concern about a larger macroeconomic downturn that is more severe. And it's been on the restructuring front. It's been on, passing on or in the profit preservation front, in passing on costs to their consumers, or even raising prices as well. What is the lever that they still have available to pull in this earnings period that they're going to have to forecast or at least disclose to the street?
Yeah, and I think exactly to your point, we've already seen some companies, and we call these quality companies, and we tell investors to sort of gravitate towards quality with tickers like QUAL. We tell investors to do that because some companies have been able to preserve their margins. Some companies have been immensely profitable. Some companies have been able to restructure, right size. Think back to the hiring practices they had in 2020, 2021, perhaps even 2022, and maybe many people sort of kept their workforces because and are probably still doing so because it was so hard to find labor, and then recognizing that the environment, the regime has shifted, and now we need to make some difficult decisions about the size of our workforce. And they've done that. Luckily for those impacted, it's a strong labor market, and we haven't really seen that pickup in initial jobless claims. So coming back to your question, though, what are the levers that companies that they still have? I mean, I would say playing their balance sheet to their advantage, taking advantage of rates when they can. I would say looking at ways that they can continue to be profitable, whether that is on the restructuring front. I would also say a lot of companies are rethinking around reshoring, supply chain resiliency. That's something that is definitely a focus of mine for this earnings season. I would also say ways to boost or enhance productivity. And I know we just had the AI conversation, but that's not the only way you can enhance productivity. What are the other ways that you're getting more out of in a pretty cost-constrained environment?
So, Gargi, when it comes to equity allocation right now and where people should go in this environment, you guys are talking defensive, and you mentioned one of those, QUAL, I think. Energy, I think, is one of the other areas you're looking at, which is
interesting.
We're not hearing that so much.
You're not
lately.
hearing that at all. So glad you asked this question. The way we're thinking about this is that broad equity markets are certainly priced to perfection. Right? And I know we were talking about this earlier as well. And yes, some of that has been because of data resiliency. But if you think about the forward earnings growth at close to 6.8% right now, if we do slow down, does that materialize? Unlikely. So equity markets priced to perfection, but there are pockets that investors can benefit from, right? And you should always remain invested. So what are those pockets? Number one, certainly quality. Number two, if you are in the camp where we are, which is a little bit of a cautious stance, then reducing your risk, reducing your volatility with something like a USMV, which again gives you sector neutral, broad allocations to the markets, but in a lower beta, so a lower or a higher downside capture. So if the market's going down, you're not going down as much. And then, I talked about this price for perfection outcome, but if we do indeed have a soft landing, a few sectors have certainly priced for a hard landing, and energy is one, which has priced for a hard landing, but obviously there are other sectors that have not. Some have priced for a soft landing, some have priced for a hard landing. So if we believe that everything's fine and we're going to have a lower than output, a lower output than neutral, but at the same time, we're not going to have a recession, then that's where energy is like one of those, we like to call it quality at a reasonable price, high cash flowing part of the market that still is reasonably priced. So again, not if you're expecting a recession, that's not where you go for the energy company names. But if you think, it's sort of like choose your adventure, if you think that this is going to be an economy that remains resilient, that we will slow down, we'll have a period of below sustained growth, but not recession, then energy companies might be that one to benefit the most.
Interesting. All right, Gargi, stay with us because we have to talk about another area of the market. Fed Chair Jay Powell still very much in hawkish mode, telling peers in Portugal that with inflation nowhere near the Fed's 2% target, interest rates will have to be higher for longer. That's been his message, of course. Most analysts anticipate another rate hike in July at least. The path there, though, is unclear afterwards. Chair Powell still has not indicated when the next hike will come. In a quote that caught some people's attention, he said, a strong majority of committee participants expect that it will be appropriate to raise interest rates 2 or more times by the end of the year. With the Fed holding tight, investors are looking for the best bets in the coming months. And according to our next guest, that's high-quality fixed income. And we're bringing back in Gargi Chaudhry, BlackRock's head of iShares investment strategy. So Gargi, when it comes to fixed income, we've had a lot of people enthusiastic about it this year for the first time in a long time because we have seen yields go up. How enthusiastic do you stay and where do you go?
Yes, thank you for this question. I feel like so much of our media outlook is around fixed income, but the questions that we've been getting have been around AI, so thank you. When there's opportunities like AI, fixed income can sound boring. But the thing is that the best opportunity right now in the market, I would call it a generational opportunity to earn these incredible yields, is actually in probably the most basic part of the fixed income market, which is high quality treasuries, agency mortgages, investment grade credit, inflation linked bonds. You can sort of own the AG, the AGG, and get about 4.7% yield. I will say the one thing that not enough people are focusing on is the fact that carry and cushion in the fixed income markets is back. And what I mean by that is this asymmetry of outcomes. So if interest rates rise by 50 to 75 basis points from here on the 10-year part of the curve, so let's say we go to approximately 4.5%, you'd still have basically a zero return. In fact, at 50 basis points higher, you'll be up about 1.4% owning the AG for a year. 75 basis points higher from here is when your returns will be slightly negative. If we have a 75 basis points lower yield environment and you own the ag, you'll be up about double digits. So that asymmetry in the market, and why does that exist? That's because bonds are back, cushion is back, carries back, yields are back. So your coupon is earning you something, which of course for the last decade and a half it didn't. So when it comes to fixed income, I think owning the 3 to 7 year part of the curve, so the belly, is where I think investors should gravitate to. So there's a little bit of diversification that you're getting. You're getting a little bit of that ballast, but you're also getting that income. And I think looking at ag, looking at mortgages, looking at tips might not be as exciting to some investors, but I think it's such a great opportunity right now for every type of investor. I'm buying it in my PA. So I'm really excited about this prospect of earning high quality carry at 5-ish% yield.
One of the great things about keeping too many tabs open is that I was able to recall my tab yesterday of the CME FedWatch tool. Yesterday, we were sitting at about a 74% chance of a hike at the next meeting. You saw it here this morning, right there on our screen, and I believe that was pulled earlier this morning, sitting at a little over 81%, and actually more recently now, as I refresh, as this moves around and fluctuates, of course, sitting at about 89% now. So all of this coming after Fed Chair Jay Powell's comments yesterday. Some of our guests also in agreement yesterday that we could see 50 more basis points to come this year. Are you in that same camp and that way of thinking, even if we are coming towards the end of this rate cycle?
Yeah, so I'll start with, think about where we were last year at this point, what we were talking about as it pertained to the Fed. We were thinking about the Fed going 75, 75, 50, or 75, 75, 75. Compared to that, right now, we're talking about maybe 2 more rate hikes. I think the Fed has to keep their optionality as much as possible and keep the options for 2 more rate hikes on the table, especially if we continue to see strength in the services and especially the shelter component of inflation, right? I mean, that has been pretty strong. Ex-shelter inflation has moderated a little bit, which is good. But shelter, as we know, is about 40% of core CPI, and that's a big number. So yes, they can go 2 more times. And I think the Fed is doing a good job by keeping that option on the table for right now because it buys them optionality. Having said that, if they do that, number one, the market's obviously priced in a lot of that. But number two, and this is the part that we stress in our mid-year outlook, is that the Fed is not going to cut rates this year, probably not till the second half of next year as well. I think that's really important for bond investors and equity investors to understand. So whenever we start seeing rate cuts getting priced in for this year, I think that becomes a little bit harder for me to talk about fixed income. But at this juncture, when we are not pricing in any rate cuts, which is going to be the outcome, they are not cutting rates this year. They're going to keep it higher for longer. And yes, if they have to go certainly 1 more time, I don't know that they'll necessarily go 2 more times. I think that'll depend very much on the data. But even if they do, I think you can still, again, we talked about that cushion earlier, you can still have a positive outcome in the 3 to 7 year part. Again, I wouldn't recommend investors going much longer than that. I don't think you should be buying 30-year yields at this juncture, but I think staying in the belly makes a lot of sense.
Gargi, stick around. We got a little more coming from you, but we had the opening bell on Wall Street. So let's do a quick check on the markets here, getting back to equities for just a moment. We've got a mixed open here on Wall Street, but really, haven't seen this little change on the open in a little while here. Wow, the Dow, the S&P, and the NASDAQ, none of them moving even 1/10%, Brad. I don't know. Brad is looking not nonplussed at all of this, or maybe you're just looking nonplussed at what you're seeing on your screen there.
Yeah, no, I feel like I should just walk back to the desk at this point. I mean, there's not really much going on, folks,
Maybe
right now.
sector-wise, I don't know.
Yeah, we'll take a look at that. How about we do that? The S&P 500 flat, Dow Jones flat, NASDAQ flat. Sectors, let's see what's going on. We got 11 of those. Certainly one of them's got to be moving. Taking a look at the 11 S&P 500 sectors here on the day. That's month to date. Let's put you on an intraday out of the gate. Okay, all right, cool. So we've got a little bit of a story to tell here for you. Utilities pulling up the caboose. As of right now, that's down by about 0.7%. We've got more laggards than gainers on the day. Financials actually leading the pack, followed by consumer discretionary. You're seeing financials, though, up by about 0.8% out of the gate this morning. As I mentioned, consumer discretionary, energy, and technology going to make up its mind at some point, but you're seeing that flat just barely to the upside as well. Speaking of technology, let's take a look at the NASDAQ 100 tech-heavy average here, and we're going to keep a close eye. We're on Apple Watch once again on the day. 189.87 is where we are right now, and as Julie mentioned earlier, the magic number to get to 190.74 for that $3 trillion market cap. Let's put that on that market cap view for you, just to let you know how close we are right now. Oh man, hair of a chinny chin chin, just not really. So we'll see if we can get to that marker on the day.
It doesn't look like it today.
It looks like it, but maybe not.
In the next week, in the next month, probably we'll get there. All right, we got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Most people we talk to, right, are in the Wall Street orbit. You're in North Carolina. Do things feel different there from a recession perspective?
Yes. And I'll tell you, Charlotte is growing very quickly. People are coming back to the office. We have a lot of big banks down in Charlotte, and the housing market is crazy. It's hard to look at what's happening in uptown Charlotte and say that we're in a recession.
Welcome back. The banking sector is stress-free, according to the Federal Reserve. The central bank conducted its first annual stress test since the regional banking crisis this spring, and all 23 of the biggest lenders in the U.S. passed, with some like U.S. Bancorp and Citizens and Truist feeling a little bit more of a squeeze. There you're taking a look at some of the overall kind of results as well as the regional bank performances here on the day. So investors, as we were taking a look at XLF at the start of the day, breathing a little bit of a sigh of relief that we made it through that point.
Yeah, definitely. Smaller banks that were under pressure following the collapse of Silicon Valley Bank like PacWest and Comerica, they weren't included in this testing. That's quite interesting that they weren't included in the testing, but we saw some of the criteria up on the screen for these stress tests. I don't know if we can say that they're stress-free entirely. We're bringing back in Gargi Chaudhry, BlackRock's head of iShares investment strategy. I mean, you know, there's still some lingering credit risks in the market, to be sure.
Yes.
Where are you still sort of concerned when you look at the financials Certainly, we're watching those loan officer surveys really quickly, et cetera. But what are you thinking about?
Absolutely. So I think it was a relief for the markets with the results yesterday. I think it's also possible that for the very short term, we have a little bit of a catch up. Obviously, this year has been so much about a few stocks leading the way higher. I think it's possible that for the next few months, we see, especially if the earnings seasons turns out okay for the financials, it's possible to see a little bit of a catch-up trade, right? Having said that, is this a sector that I feel super comfortable about, knowing that there is going to be more regulatory pressure coming our way? I would say that investors are probably still supposed to stick to those quality companies, again, focusing on profitability, margin resiliency, and to the extent that there is some concerns still around financials and broadly around regulation of financials, I am still not in the camp of owning financials quite yet. But I will say temporarily, I could see us, especially if earnings season gets by with okay results, I could see us having a little bit of a rally. Having said that, what am I watching? Senior loan officer survey is obviously top of mind. That has been declining, and I think credit conditions is something that we will be talking about, particularly in the second half of the year, because we haven't really seen some of that impact quite yet.
Is commercial real estate at this point still a significant risk within the broader banking system, considering that was the next area that everybody pointed their attention to, saying that it would potentially be the next shoe to drop?
Yeah, I think people are still concerned around that. I think that is probably going to be an area that is going to remain under focus. I think we have to look at the numbers of where people are going for lending purposes. They are going to the smaller banks. They're going to those much smaller than 100 billion size banks for those loans. And to the extent that credit is tightening, continues to tighten, I think it's going to be tough for certain parts of the commercial real estate sectors.
Gargi, thanks so much for spending so much time with us.
Thank you for having me.
This was really
awesome.
fun. Appreciate it.
Great.
Gargi Chaudhry is BlackRock's head of iShares strategy. Thank you. Well, let's get to some movers now that we are about 10 minutes into today's session. We're watching shares of Rite Aid. The shares are moving a little bit higher this morning, about 2.5% after reporting fourth quarter earnings. The company reported $5.7 billion in revenue. That's a decrease from the year prior. It also saw net losses come in narrower than expected, though, at $306.7 million. When it comes to pharmacy, it helps to put things in perspective here. Rite Aid is a shadow of its former self. It's in last place behind Walgreens and CVS, by a lot, whether you're talking about market cap, whether you're talking about sales, whether you're talking about number of locations. The market cap of Rite Aid is now just $86 million. That is not a typo, $86 million. It's pharmacy sales. That doesn't include pharmacy services, by the way, around $18 billion. That's versus more than $100 billion for the likes of CVS and Walgreens Boots. And of course, CVS and that doesn't include the insurance or the other parts of the business. That's just the retail and pharmacy part. So it's so interesting because it's such a brand name still, but it's just the other two are just so much bigger. Yeah,
still a brand name. I mean, for Rite Aid, and I really think back to when we were talking about this earlier, about the deal that was kind of much larger than it eventually netted out to be. There was I forget the total original dollar figure, but it came down eventually, a deal between Walgreens and Rite Aid that netted out Walgreens with about 1,900 locations of Rite Aid that they later on started to initiate a rebranding process. That was a deal that was worth $4.4 billion. However, it's because they stepped off of a much larger deal. It's the multiple about 3-4x, and essentially just said, you know what, it's going to be more advantageous if we just go after a select amount of stores in regions that we want to be in instead of purchasing this company in totality. Now you're taking a look at Rite Aid and going up against a Walgreens and a CVS that I would argue probably have a much better ability to source inventory, move through inventory, have annexed a lot of the insurance product as well and those services too. And so all of that considered, Rite Aid has had a tough go of it, to say the least, over the past several years. And these numbers may have looked better, but they still have $2.9 billion in debt, and they've got an interim CEO. So this is still one to watch.
Joby Aviation, that's another one to watch. The stock is surging. On Wednesday, the FAA gave the company the green light to test its electric air taxi. And this morning, the company announced that South Korea's SK Telecom is investing $100 million in its business, expanding the partnership between the two companies. Now, we talk about this as an eVTOL company. Vertical takeoff and landing.
Yeah.
So it takes off like vertically, but then flies like a plane.
Yeah.
Is how this works. So people are excited about it.
Magnificent. I can't wait to ride one of these.
But I don't know when that's going to be, Brad.
I don't either, but for Joby, they've gotten a ton of attention over the course of this week. And if there's anything to say that it could be closer than we think, they had also gotten a significant approval this week from federal aviation authorities as well to move forward at least with some of their more controlled flight and testing. So that's something that investors can perhaps in this near term, in this blitz of headlines that we've seen come out of Joby over the course of just the past few days, can hang their hat or at least their overhead storage on for a little bit.
And the goal is for them to deliver their first products to the U.S. Air Force next year as part of the contract. So you and I might not be flying in them, but it's possible the U.S. Air Force will be flying them next year.
Maybe we'll get an invite from the Air Force.
Maybe.
Just to test it out.
Yeah, that would be nice.
Also, we got to talk about one of the tastier companies that's reported earnings this morning. We're also watching the company behind those seasonings on your rub this weekend. McCormick. Shares of the company, yikes, dipping today. Despite beating Wall Street expectations and raising its full-year outlook, sales, they grew 8%, aided by higher prices here. And this was particularly interesting to look through for McCormick here because I don't know that I've ever been that enamored by some of the segments. I mean, it's pretty straightforward. They got a consumer segment. They've got a flavor solutions segment. I just wonder what you have to do to get the title of president of flavor solutions at McCormick. That would be kind of cool. But at the end of the day, the growth in that particular flavor solution segment, mighty flavorful for some investors here. That moved higher year over year and quite handily, coming in at about $747.1 million versus the $670.7 that they saw a year prior there. And then on the 6-month period, also continuing to show some significant growth, increasing by about 12% from the second quarter of 2022 is kind of the round figure, if you want to put it on there.
Yeah, I was just looking up to see if there were any more headlines coming out of the conference call or anything, because it's a little bit confusing why the stock is down. It raised its full year forecast for earnings. Sales just came in line with estimates, and they didn't change their sales forecast for the year. So perhaps there's a little bit of disappointment bound up with that. I always have fond thoughts about McCormick because it's based in Hunt Valley, Maryland, which is not so far from where I grew up. And periodically, if you drive by a McCormick facility, you will indeed smell the spice mix wafting through the air, which is kind of a fun thing.
Such a great word, wafting, especially when it comes to spices. A lot of people are going to be seeing those scents and flavors wafting through their backyards over the course of this next week.
That's true.
But it could be on the volume decline as well. They had a 1% volume decline within the flavor solution segment. Also, 1% volume decline from the company's strategic decisions to discontinue their low margin business in the consumer segment as well there. So perhaps there's a little bit more color that they're providing on that, or a little more flavor they're providing on that.
And just so all of our viewers know, Brad has now named himself President of Flavor Solutions.
At least in Slack. You can be anything you want in Slack.
It's true.
Including Alexis Ohanian's best friend. He is my profile picture in Slack, for anybody who was wondering. Anyway, we've got all of your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. It's real.
I didn't realize
Don't lie.
Do we think a recession will happen this year?
So we don't know, but we know that expectations seem to keep getting pushed further and further out. And one of the things that I wrote about this week was a note from Credit Suisse that says the recession won't actually start until the yield curve uninverts. And right now, futures don't put that until 2026, which is pretty incredible. We'll see.
I'm going to say no. I'm going to step out and say no. No, the economy's been stronger than we thought, and I think we can push it out another 6 months.
Stocks are looking to end the week on a high note as the second to last trading day of the second quarter and the first half gets underway. Let's get to Yahoo Finance's Jared Blickery on the floor of the New York Stock Exchange. What's the vibe down there on Wall Street, Jared?
Oh, I would say there's tons of excitement standing right where I am because I'm looking at the Wi-Fi Interactive and I see the Dow leading today. We had a pretty ho-hum start, as you were talking about, Brad, but the Dow up about 1/3%. I want to take a look at the longer term picture though, and since we're approaching that half of the year mark, and by the way, I'm going to do a deeper dive on some of the statistics in the 11 a.m. hour, but just wanted to show you year-to-date S&P 500 up 15 or 14% there. From February to May, we kind of had dead money, but it's been up and away, especially in the month of June, and that was when we saw volatility drop below many critical thresholds here that we have in the VIX, and its many varieties and its many derivatives. But here we go. In the very first part of June, on that non-farm payroll report, we did get a drop below resistance in volatility, and that facilitated finally a move higher in the other stocks besides the mega caps, because that was the dominant story up until that point. I want to give you a check-in on the rate market. This is year-to-date, still looking at the 5-year T-note yield. That is broken above its recent trading range. Not so for the 10-year, still at the upper end of its trading range. We can also take a look at the 13-week T-bill as a proxy for what the Fed is doing. That is still in a trading range. But the US dollar ticking a little bit higher. So what's the story going to be for the second half? I'm going to lay out the probabilities in the 11 a.m. hour, but I want to show you a longer term chart of the constructiveness of the S&P 500. Here is a 2-year look. We recently punched above the August highs and we are maintaining those highs, so that's very bullish. If we were to sink back below, especially with a chart this long term, it might augur for a false break to the upside, which would mean more downside action, but that hasn't happened. We need to close below that yellow line, and I'm guessing beneath the recent price action. So I can also show you the NYSE FANG TMX index, and this is something that's closely tracked, especially because of the outperformance of the mega caps. This is up 73% year to date, and nary did it look back that much at all. It's just been from the lower left to the upper right most of that time. Very impressive considering what we've seen not only this month but also this quarter. So let me go over the sector action. This is what's happening today. Financials in the lead, not surprising after we got that resounding stress test passed by all of the banks. But let's check out what's happening on a month-to-date basis. We got consumer discretionary, that's XLY in the upper left, followed by industrials and materials. Those are the outperformers. That's retail, industrials, and materials. Those are not growth stocks. Those are what you would consider stocks that are levered and sectors that are levered to the everyday economy. Very important that those have been making headway, because you look at the quarter-to-date stats, because of that huge outperformance in April and May, we still have the mega caps and their sectors outperforming. Tech is a #1 winner, up 13%, and for the month, consumer discretionary is still the winner.
Interesting stuff. Thanks, Jared. Appreciate it. XLY up 9%. Well, Alphabet is facing some rare bearish calls on Wall Street with 2 downgrades in the last week. Bernstein cautioning that investors that it's time to move to the sidelines with the tech giant as it sits at a price with a balanced risk reward. The analyst behind that downgrade, Mark Shmulik, is joining us now. Not only do you talk about the balanced risk reward, but you say thanks for the warm hug to Alphabet. You say that the stock is normally like a warm hug. I guess if we stretch out that analogy now, it's like a smothering embrace. I don't know with the valuation where it is. I mean, is this call pretty much all to do with where the stock is priced right now, Mark?
Yeah, exactly. I guess if it was a warm hug, maybe they've been hanging on too long and, you want a little bit of personal space. And I guess that's natural for an investor. When the stock's up 40%, year to date, and a lot of that move has been kind of driven by a re-rating in the multiple tied to first getting hit off of a negative AI narrative and then recovering, with a very positive AI narrative. And yet underneath it, there's been very little change to kind of the underlying fundamentals. And so I always get a little bit nervous when a stock runs up into my price target. And a lot of that is driven primarily by narrative, but no real dramatic change, in fundamentals. And, when I stepped back and actually looked at the fundamentals, the story ahead of us, ignoring or putting the AI piece to the side, tells me a stock that feels very fairly valued from a risk reward perspective right now.
And so part of this too, you mentioned from too slow to too fast in AI. Talk about the too fast side. What is that, if there's any clarity around how much they might be spending in this near term on generative AI in order to not miss out on what that wave could mean for their business and perhaps compromise market share, how you're evaluating what that spend may look like as a profile basis for this company?
Yeah, of course. And, there's a couple kind of factors to the question. But, the first part is, they were perhaps caught a little bit off guard at the start of the year with some of the announcements, the immediate success of ChatGPT, Microsoft's push into search with Bing. And so there was what we've actually seen from them is a real pivot and moving very quickly to get, AI out there and integrated everywhere at a speed of which we've never really seen in a very long time from Google. So on one hand, that's really great to see such a fast product shipping cadence. On the other, when we're already starting to see generative AI embedded in kind of core Google search results and kind of SGE, what it's done is it's taken up valuable real estate from otherwise, those very famous blue clicks that they make a lot of money off of. And, what we've observed since March is, open roles on Google have quadrupled. We know CapEx is going to come up as everybody's, arming themselves up for this AI arms race. And so our worry is when we look at Google relative to some of the other companies in our coverage, they weren't as aggressive taking cost out as we've seen certainly from the likes of Meta, which means as they're absorbing these new costs, there's just a lot less headroom for them to absorb.
And one of the other things you mentioned in your note that I thought was interesting is the regulatory landscape. Of course, regulators have been looking at big cap tech for years, Alphabet included. What do you think is particularly maybe risky about the current possible regulations for Alphabet?
Yeah, regulation's always tough to handicap. There's always something going on. And I think what I'd look at it is kind of from two lenses. One is just the amount of regulatory activity. And there's certainly cases, in Europe, their compliance with the DMA coming down. They're most exposed in terms of the amount of work they need to do to comply. There's the case on their network business, which if they're found kind of in violation could be a fine of up to 10% of global revenues. So we're talking bigger financial numbers. And then perhaps more interestingly or more importantly on the docket here in the U.S. in the fall, the case is going to trial really around their core search business and, exploring that relationship that they've had with Apple, where they've effectively been paying to be the default search engine on iPhones. Now, unclear if anything comes from it, but there's clearly a lot of activity kind of hanging over Google at the moment.
All right, so from here, we're looking at an Alphabet that has also got multiple subsidiaries under it that I think have come under fire recently, especially with YouTube and one of the more recent discoveries that perhaps they weren't. I was reading into this yesterday, and I'm still not sure I fully understand it myself. Perhaps you did as well, and just how some of these service level agreements may have been violated and what that may mean going forward for the company in terms of having to forfeit or at least repay some of their customers. Is there any clear kind of analyst take on that from the street thus far?
I'll share my kind of very initial kind of knee-jerk take on it, which is, the report that came out was effectively that when you buy ad inventory on YouTube, they also sell you ad inventory that's off of YouTube. Now, there's very specific measurement requirements and placement requirements to make sure those ads are front and center and that the viewer is actually watching them. And I think what that report was pointing to is that allegedly YouTube was putting some of those ads maybe in the sidebar and started to autoplay where you might not have seen it, but then you'd effectively have to pay for it. Now, that's unclear, to what extent whether that was happening or not. I don't have any view on that yet. But what it does tell me is, we've kind of forgotten about it these last few years, but there's always been, advertiser hesitation with YouTube. Prior to the pandemic, there was almost an annual advertiser boycott for something to do with either placement of the ads, brand safety of the ads, or really just the associated quality. So all it does is bring some of those advertiser fears back to the forefront, which just pressures the ability for YouTube, growth potential.
And ahead of a general election year as well, Mark. So there's that kind of added on to it. We have to leave things there for now. Can't wait for even more of your insights and your take on that particular matter. Mark, thanks for taking the time here with us today.
Great. Thanks for having me.
Absolutely. All right, stay tuned, everyone. You're watching Yahoo Finance.
What is your year-end target for the S&P 500? Or if you don't have one, where do you think we're going?
Yeah, we actually don't have one, but we are cautious right now.
And what does that mean, cautious? Like, do you think there's going to be a new low for stocks, for example?
So no, and we think that we're in a bull market right now. Bull markets can be very fierce, but at the same time, we don't see the S&P making new highs. That could be a tough journey.
Welcome back, everyone. It's just after 10 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman, and we are 30 minutes into trade here on the day, 33 minutes in to be exact. The S&P 500 right now, you're seeing that trading higher by about 0.2%, as well as the Dow and the NASDAQ also in positive territory. Let's take a look at some of the top movers, though, this morning early in trade. First up, Micron. The stock is higher in pre-market trading early Thursday, but now falling. The chip maker reported a Q3 loss, which was narrower than expected, but exceeded analyst expectations on revenue. The company's earnings call, Micron said its business is benefiting from strong demand from its memory chips and easing supply buildup of traditional PC and smartphones.
Shares of BlackBerry, that's not one that we talk about so often these days, but the shares are jumping some 10% today. Effectively, the company is much lower stock-wise than it used to be. It posted a surprise profit for the first quarter after seeing resilient demand for its cybersecurity products. Revenue in BlackBerry's cybersecurity business unit was up 5.5% to $93 million. Revenue from licensing and other services came in at $235 million.
And Virgin Galactic stock in the red. The stock was rising earlier in pre-market trading ahead of the company's first commercial space flight. The flight, dubbed Galactic 01, will launch from Spaceport America just outside of Truth or Consequences, New Mexico. The flight can be watched over live stream at 11 a.m. Eastern Time. I'm not sure I knew that was the name of the city.
Truth or Consequences, New Mexico.
Right.
That sounds like a serious
folks.
place. Let's talk about pending home sales, which we just got out a moment ago. They shrunk 2.7% in May compared with the prior month. That's according to the National Association of Realtors. And while 3 U.S. regions posted monthly losses, sales in the Northeast surged. Let's bring in Yahoo Finance's Danny Romero to weigh in. So this tells us sort of a forward-looking indicator, right? Because it's pending home sales.
Yeah, so the lack of homes is not keeping up with demand. There were 3 offers per home that was listed in May. So the competition is fierce out there. It is heating up, and due to the fact that there is such a small pool of homes available right now. Still, pending home sales is down about 22% from a year ago. And regionally, the Northeast is the winner here. There were more contract signings there. And to give you some perspective, homes that are listed in the Northeast are going for about $270,000. That is about a 20% cut from a year ago. So who are the people that are moving to the Northeast? That are people from Buffalo, San Francisco, Springfield, Massachusetts. That's what Redfin has pointed out. But across the board, the other three regions did have contract signings dropped on a monthly basis. So the housing shortage really is the story here. And remember, home builders are ramping up production, but some experts say that really that could be insufficient, and the fact that supply could also take some time to really reach the market. One economist at the National Association of Realtors pointed out and said that there should be a focus on boosting existing home sale inventory by adding tax incentives.
Oh, interesting. So that would be sort of a state-by-state basis.
Yes.
That would be done. Huh, interesting stuff. Thanks, Danny. Appreciate it. Well, it is clear we're starting to see some stability in housing as more home buyers are adapting to higher mortgage rates. Our next guest says Americans won't be seeing any sort of spiraling crisis in the housing market, at least not for now. Ben Eisen is with us. He is reporter for the Wall Street Journal. Ben, it's good to see you here. We just got those pending home sales seeing decline. But the dynamic that really seems to be dominating right now is that there are just not enough houses out there as we see mortgage rates continue to persist at relatively high levels. So what's your take as you think about the housing sector?
Well, thanks for having me, guys. It's been an interesting situation to watch the housing market over the past year. I think, when we were thinking about what was in store for the housing market a year ago, when the Fed was in the middle of raising rates at a super rapid pace and mortgage rates were going up super rapidly, there was kind of an assumption that we were going to have this big dip in home prices. And while we've definitely seen that in some areas of the country, the overall housing market has held up relatively well. And as you mentioned, it really comes down to that lack of supply. So even if you have this sort of reduction in demand, you still have a lot more demand than supply. And, home builders can't build fast enough. And what you're seeing is that people have really sort of become a bit more accustomed to the state of affairs right now. We've seen mortgage rates rise really rapidly, but they've been in sort of a range between 6% and 7% for much of the last year. And as a result, you see people start to get used to those rates, and demand starts to come back in. So you've seen a slight rise in existing home sales. You've seen mortgage applications up over the past couple of weeks. You saw that dip in pending home sales, but you saw that big surge in the Northeast, suggesting that there's definitely kind of this pool of demand that's still out there, and that's likely to kind of help bolster home prices. It's hard to say what's in store going forward, but for now we're not seeing this kind of precipitous decline in home prices.
Do you expect, one of the things that's been kind of trending, I believe, in social conversations over the past couple days now is the amount of rental properties that were purchased over the course of the pandemic for low financing. And now that there has been even this resurgence of travel, there still is a concern from some of the owners of those rental properties that they're not seeing enough traffic because there are other more affordable options that are out there. So all that considered, could we see a wave of potential new homes, existing homes, come back on the market? And what would that do in the current demand profile that we see right now?
It's certainly possible. It's on the existing home sales side, what you have is you have these people that sort of feel locked into not selling their homes. So maybe people who bought over the last couple of years, or even further back, but and they like to move up to a new home and put their home on the market and sort of jumpstart this kind of movement of houses, across the housing market, but they don't want to give up a 3% rate, take a 6% rate. And that's been one of the sort of key factors keeping demand off the market. That said, if you see rates continue to stabilize and you see people get used to it, and be willing to kind of factor that into their budget, then you start to see those people put their existing homes on the market and jumpstart the movement of housing. And that said, there still is this kind of push and pull between whether it is better to rent versus own, in terms of factoring that into a monthly budget. And the rise in rates has definitely appended that calculation. But we are seeing kind of like the top, we had a lot of people move back into the rental market or, decide to rent rather than, buying immediately. And so you had that rise in rental prices. And now you're seeing that equation kind of start to rebalance again. And the rapid rise in rents that we saw has kind of topped out and is coming back down to earth. So, some of the kind of dramatic movements that we had last year and all of that is, starting to reverse or at least stabilize.
Ben, I want to pivot topics, but just briefly before we do that, in 15 seconds or less, what will be the true measure of whether or not the Fed wins its fight against inflation, at least as indicated by the housing market?
That's a good question. I think the Fed probably doesn't want to see home prices rising double-digit percentages in some of these cities that continue to be hot. The thing that makes it hard to look at the housing market right now is that it's a series of regional markets. It always has been, but you're seeing wide divergences. So home prices falling in some places, but surging in other places. So to see that kind of calming down in some of the hottest markets, I think is definitely one thing that they'll be looking at.
And Ben, talking of banks, I want to get your take on the banking sector. The Federal Reserve conducted its first annual stress test since the regional banking crisis this spring. We got the results yesterday. All 23 of the biggest lenders in the U.S. did pass. Some, like U.S. Bancorp, Citizens, and Truist, did feel a little bit more of a squeeze as we looked at the criteria. But as we near the beginning of the new quarter, big banks like J.P. Morgan and Goldman Sachs could be facing tighter profit margins as a result of all of this. So as you look at the results of the stress tests, as we look forward, what signs are you looking for from the banks?
The stress tests are pretty interesting because they put out the scenarios that they use to stress test the banks before the regional banking crisis that we saw, and those tests had sort of as their what they were testing against was a big recession in which interest rates decline, and you start to see a lot of the kind of the opposite things than what caused the regional bank failures that we had. So in many ways, it's sort of backward looking. And so you saw all of these banks come through and they looked pretty strong and they looked like they were doing well, which in many cases they are, but they also were sort of testing against a scenario that is not quite what we're seeing. So, that's just one thing to keep in mind when you look at those stress tests. And, I think we're going to be seeing other regulatory moves as we kind of move forward throughout the summer. There's more regulations that are kind of being considered right now, and other ways that regulators are devising to kind of test the banks. And I think as a measure of bank health, the banks look good, but this was sort of backward looking, for the moment.
Ben, good to see you. Thank you. Ben Eisen, a reporter at the Wall Street Journal. Appreciate it.
Thanks for having me.
We got all your markets action coming up ahead. Stay tuned. You're watching Yahoo Finance. Which one do you think will win, Musk or Zuck?
Zuck's pretty built. I gotta say Zuck.
That's an easy one. Disney shares are trading down this morning after the company was hit with a downgrade from KeyBank. Yahoo Finance's Alexander Canal joins us with more. The shares aren't down much. It's only about 1/3 of 1%. But what's this downgrade about?
So it's about the meaningful uncertainty. That's what KeyBank is noting here. They downgraded shares to sector weight from overweight. And the analysts, they cited 5 main areas of concern. That includes stalling direct-to-consumer subscriber growth, a failure to differentiate DTC churn, sagging Disney content sales, and, quote, a materially harder reality for moving ESPN to streaming, along with further fears that domestic park expectations, especially in the U.S., remain too high. Now, on the park side, that has been a consistent outperformer for Disney. We saw operating income hit $2.17 billion in its latest quarter. We also saw a surge in international parks as well. However, according to KeyBank data, they see that growth has stalled, especially in the months of April and May, and they worry those tough comps are not baked in to the stock price at this point. The analyst writing, quote, "We prefer to step aside, acknowledging meaningful uncertainty and wait for further catalysts as buying the dip has been a losing trade." Now, we know Disney, along with a lot of these other legacy media companies, they've been really going through it at the moment. A part of it is macro. Other areas are just challenges within management and leadership. We know Disney CFO Christine McCarthy is stepping down due to family leave. We're waiting to see who the next permanent CFO will be. So a lot of changes at all of these media companies right now. And I think that's giving a lot of pause to analysts and investors to sort of wait it out and see how this plays.
Let's stay in the entertainment landscape. It's been more than a year since the merger between Warner Brothers and Discovery. How are they doing?
Well, if you look at the stock price, you would probably say not well. We're down very consistently since that company debuted together. And they've been hit with a lot of challenges, especially recently. We saw The Flash bomb at the box office. This was a movie that a lot of executives at Warner Brothers Discovery kept championing, saying this is the best superhero movie we ever saw. And then the box office results, they just were not good. We also saw the firing of CNN CEO Chris Licht after that really scathing Atlantic article. And overall, the company has just been going through a severe restructuring, a lot of layoffs. Warner Brothers Discovery has been in the headlines for really not positive reasons. So you could argue more losses than wins here. However, media experts and analysts that I've spoken with are pretty confident in the company moving forward. They have a ton of confidence in David Zaslav. I was speaking with Jessica Reif-Ehrlich from Bank of America. She said he is a CEO who knows when he's wrong and then does something about it, immediately changes the course. And that's something that this company really needed. We've seen a lot of cost cutting, and that is going to help pare down their debt along the line. So right now, a bumpy road ahead, but in the future, analysts overall seem pretty bullish, which is an interesting take considering how many problems this company has faced recently.
Yeah, we'll see. Thanks, Allie. Appreciate it. Well, a months-long battle between AMC and retail investors over a stock conversion plan will come to a head today in court. Retail investors accusing the movie theater chain of rigging a shareholder vote to convert preferred stock to common stock, issuing hundreds of millions of new shares. This is a 2-day court case, so we should get some kind of resolution to it tomorrow. But at issue here is this plan between the AMC shares and the APE shares and the conversion of one to the other. And again, these investors in the company are alleging that the shareholder vote was somehow rigged to approve this getting done in the first place. You see there the APE shares trading a little bit higher in today's session.
Yeah, and this was about, for AMC at least, being able to begin paying down some of its debt. The issuance of these shares also were as a result of the fanfare that had really been drummed up as a result of the short squeeze that was initiated by the retail trading frenzy in early 2021. AMC, of course, with a host of other companies, none more so known than GME as well, and GameStop. And so all that considered, you've seen this contentious kind of back and forth, even as AMC had kind of used this, or at least marketed this as a mechanism to get closer to its retail traders. It seems that there was something else clearly at play here. There could be a class action settlement. There's going to be a chancery court that evaluates that potential as well.
Yeah, and those who are suing here, a Pennsylvania pension fund and an individual shareholder, and what they're alleging is that AMC won the vote through what this lawsuit says are heavy-handed tactics and financial trickery, they say. So we'll see what ends up happening
Indeed.
with this situation.
Everyone, we're going to continue to monitor that, plus all of the other tickers that we've been bringing your way this morning, and a few more that we have yet to discuss. Stay tuned. You're watching Yahoo Finance.
What does GDT Bath stand for, Callie?
Oh, this is my favorite. Good day to be a Tar Heel. I'm a huge UNC fan.
Okay, that makes sense then.
Planes, trains, automobiles, and buggies even. We're taking off into a big travel weekend ahead, with AAA predicting a record number of Americans planning to pack their bags for 4th of July. So what should you be expecting if you're one of them? Robert Sinclair Jr., AAA Northeast Senior Manager, joins us now live in living color in studio. Great to have you here with us.
Good to be here.
Help us set the scene, set the tone for this big travel weekend that's coming up.
Very busy. Record number of those who are overall travelers, those who are driving, 43 million, flying, 4.1 million. And of course, we've talked about how we measure things differently, where a trip out west for somebody flying is one trip, yeah, there and back, even if they have connections. So busy. And the other category is just 300,000 from setting a record from 2019. So those are trains, buses, and cruise ships. And cruising is very busy. So it's busy. 85% of those who are traveling, though, are driving to their destinations. Gives you the freedom to go when you want, make up your own schedule. You have transportation at your destination, so that's the overwhelming mode of choice of travel.
So speaking of schedules, I have a selfish question for you. When is going to be the busiest time on the roads?
Today and tomorrow, usually after like 2 p.m., really hits crunch time, 3, 4 p.m., because you've got commuters mixing with holiday travelers. And so, it all comes together at the same time and it gets very, very busy. INRIX does anonymous vehicle tracking for us, and they're saying that in some locations, we're going to see traffic volume 64% above normal at those times. So
maybe I need to adjust my leaving time.
You should go jump in your car now.
Right? Okay, guys, I'll see you later. I'm going to go.
With that in mind, though, that means you're sitting in your car for longer.
Yeah.
You think about some of the electric vehicles that'll be on the road as well. How have you kind of looked across the fleet of vehicles, or the kind of total volume of vehicles that travel during a time period like this, and look across that particular subset within electric vehicles to know how frequently they'll need to be charged, how much, even though they're not spending as much as traditional ICE and combustion engine vehicles to fill up, how much time that adds on because you've got to sit and charge it?
Well, we have electric vehicle charging trucks in most of the major markets around the country, but only 1 or 2 per market.
Interesting.
Electric vehicles make up about 1% of all the registered vehicles on the road. Lately, the sales are through the roof. The first quarter of this year, the sales were like 68% above last year and 7% of all new vehicles. But they still haven't penetrated to the degree that we anticipate that they will one time. And consider there's 177,000 gas stations in the country, but only 109,000 electric vehicle charging stations. Gas up your car in 2 minutes. It takes 20 minutes to charge up your electric vehicle, so we probably need 10 times more electric charging stations. They're on the way. We calculate them based on numbers in the market. Our market is rife. There's lots of electric vehicles here. So that's why we've got 2 trucks in our region. But as you get up across the country, it gets a little more sparse, but it's going to grow.
You said there are how many charging stations?
109,000.
That's actually more than I thought, and that probably doesn't count home charging stations.
No, it does not.
So
Those are
it's
public
actually
charging stations.
more than that.
Yeah.
But I do wonder, for the families who have a gas-powered car and an electric car, and they're setting out to make a weekend or a week-long trip versus their daily commute, are most of them probably choosing that gas-powered car?
They're taking the gas-powered car because the Great American Road Trip is very difficult to do in an electric vehicle. You have to do a lot of advanced planning. Tesla is very helpful with their website, letting you know where their charges are and how long it'll take you to get there. But still, for total freedom, gasoline is the way to go.
And so let's talk about the other part of this as well. I mean, we're tracking and talking about a lot of the vehicle travel that's going to be taking place. Are people then instead saying, you know what, for ease of just making sure that I can get to my destination quicker, are you seeing more people now start to opt for flying or other modes of travel?
In the other mode, cruising is very big. There have been some discounts and people are taking advantage of them. Still discounts to be had, still bookings available. AAA is one of the largest leisure travel agencies in the country, so we pay attention to that sort of thing. But car travel is still overwhelmingly popular. One thing, though, that's sort of an anomaly this year compared to last. Gasoline prices are about $1.30 less this year compared to last, but demand for gasoline is down 4.4% so far this year, and 20% below 2019, even though we've driven slightly more miles, 162 billion miles in the month of April, according to the Federal Highway Administration, which is about 0.1% more than a year ago. So gas prices are cheaper, we're not burning as much, yet we're driving more miles. I'm thinking internal combustion engines are more efficient. Every new ICE engine is more efficient than the one before, and the proliferation of electric vehicles is helping. But I think a lot of people, because of inflation, they don't have a lot of extra money for non-essential driving. They're paying food prices, the inflation is bad. Shelter, particularly in our area, is very bad. So there isn't a whole lot of money left over for non-essential trips. And I think back to a survey we did in 2018 during a good economy, and 40% of drivers said that $3 a gallon was the pain point for the price of gasoline. They'd have to cut back in some other area of the family budget in order to afford gas at that price. We're at $3.57 now, and the economy is not as good. So I worry that that number is higher.
Yeah, I'm really curious about that. As you look at travel trends and what still seems like a really strong travel environment, as you've been outlining, are there signs within travel where you see people cutting back? Are people taking shorter trips, for example? Are they being less extravagant when they're at their destination? How is that working?
That's probably it. They might be cutting back on the distance and the activities that they engage in at their destination. Americans get the fewest number of any vacation days of any workers in the industrialized world.
It's a shame. We need to change that.
Yeah, we do. I mean, look at Europe. They take most of August. Most of Europe takes
And they
August
have a siesta as well.
Yeah, exactly. So when we get a free day, a free vacation day, we combine it with other vacation days and we make a go of it. I mean, we're anticipating this is a 5-day holiday, Friday until Tuesday. When the holiday is on a Wednesday, it's 6 days. So people for the holiday, they will be traveling, but I think for the rest of the year, they're kind of pulling back a little bit as far as their road trips are concerned.
It's remarkable to me that you mentioned cruises twice in this conversation. Once at the outset and then once later on in terms of where things are starting to reemerge. And we've seen that in some of the stock price performance. I mean, if people have been sleeping on it, Royal Caribbean, however they're pronouncing it at home, it's up like 184% in terms of the share price action over the course of this year. So clearly that recovery is continuing. From the AAA perspective, though, what would you look to say that cruises and the cruise industry has made a full comeback?
I think the elimination of restrictions on cruises after COVID is what is bringing everybody back. People have always loved cruising. And if you're in a place, you live in a place where you can just drive to the dock, like here, it's especially good. You drive, you park, you ascend the gangplank, somebody sticks a drink in your hand and the party starts. You don't have to get on a plane or anything like that. So I think that has improved the appeal, and all this pent-up demand from COVID is now just being unleashed, and people are taking cruises like crazy.
They'd have to have me double fisting getting on that cruise in order to get me on the vessel, quite frankly.
I don't know, Robert, it sounds like you're a cruise fan.
Yeah.
To be honest, no. Those places start getting a little small. I mean, the ships are huge,
Bingo.
but after a day or two, they start feeling very small. I like wide open spaces and be able to hike and that kind of thing.
You join the club here, but we're still looking for the person on set who's a cruise
You can
fan.
find a fishing boat or something like
There
that.
you go.
We're
There you
doing
go.
a lake. Yeah,
Take a trip to Guatemala to see volcanoes. That's what I want to do next.
Actually, that sounds way better.
Yeah, there are 25 volcanoes in Guatemala.
Active volcanoes?
Active volcanoes in Guatemala. A co-worker of mine is from Guatemala.
Very cool.
Yeah, so that's where I'm going one of these days.
Yeah.
Maybe we can make a trip.
Sign me up.
All right, Robert Sinclair Jr., AAA Northeast Senior Manager. Great to see you as always.
Good to see you. Thanks for having
Especially
me.
ahead of a very busy
holiday
weekend. All right, we got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Song of the summer, the Barbie theme song.
Nice. Okay, cool.
Excited for that movie.
Yeah. I can tell. You got the pink. You're ready.
Yep.
Bed Bath & Beyond is back, sort of. Overstock.com is going to adopt the bankrupt company's domain name after buying its intellectual property for $21.5 million. That renamed site will debut in Canada within the next week, followed by a U.S. rollout in the weeks to come. Shares of Overstock, by the way, this morning are up 13% on the news. The rebrand, the latest move by Overstock to capture more market share in the home goods and furniture space. Joining us now, first on Yahoo Finance, is Overstock CEO Jonathan Johnson. Jonathan, great to see you in person. Thanks for being here.
Thank you, Julie. Thank you, Brad, for having me.
I mean, I have to say, we've been captivated by the Bed Bath & Beyond story, so it's so interesting to see you all taking over the name. We have talked about before the re-imaging and pivot that Overstock has done and the work that you've tried to do to get customers to see what Overstock is. So how does now attaching the Bed Bath & Beyond name do that for you?
So we think we've had a lot of headwind with the Overstock name. We haven't been a liquidator for over 2 decades. It's been headwind for customers who come and expect liquidation products. It's been headwind for customers who find what they want but have some niggling concern that it might be an Overstock product even when it hasn't been. So there's been that headwind. Suppliers have also sometimes been hesitant to associate their brand with something that felt like liquidation. So all this headwind has hurt us as we've gone to be a 100% home retailer. Bed Bath & Beyond, on the other hand, the generic meaning of those words is just who we are. In fact, we think we're Bed Bath and a bigger and better beyond. And so when this opportunity came up, it just made a lot of sense. We think it will help us with suppliers, help us with customers, as we have transitioned a year ago to a 100% home company.
We've seen the IP of formerly fallen retail companies be scooped up in the past like this before, whether it's Dick's Sporting Goods getting the IP of the Sports Authority, whether it's the True Kids acquisition of Toys R Us and their IP. And so all of that to say, after that, it's hard to tell what determines successful acquisition of some of that IP. From your perspective, how would you determine this a success? What is the marker that you would look to say that us purchasing this IP was the right decision?
Well, first and foremost, our number one metric is going to be, are we increasing active customers? You know, that peaked during the pandemic. It's been sliding. The customer lists that we've acquired from Bed Bath & Beyond are much larger than ours. I think we'll see active customers go up. I think we'll see revenue go up. You know, what happens to some of the other metrics? AOV may come down a little bit. We know we'll spend more on marketing, at least initially, as we're going out and reaching to these customers, making sure our Overstock customer feels welcome on the newly branded Bed Bath & Beyond site, and that the Bed Bath & Beyond customers see what they want and re-engage.
So you talked about the advantages of acquiring the name. What about the disadvantages? I mean, this is a failed retailer. So when you think about the optics of attaching now your brand to that, how do you factor that in?
So we spent a lot of time looking at this before we did this deal. The brand is still very strong. Customers associated with home, they love the loyalty program. Mismanagement can run companies into the ground, but it doesn't really, we don't think it's hurt the brand here. You know, and as we watched Bed Bath go through what it was going through, there was, you know, a ton of social media. We want it to be around. And so we think that it will be a little different than other companies because we're really adopting the name. It's going to help propel us forward. It's taking headwind and turning it into tailwind. And I think that has huge potential upside.
Are you expanding the products that you're offering as part of this?
We are. We've been working on breadth and depth. Recently, we've been particularly focused on bed and bath products. We've got already a bigger Beyond. In the week after the news broke that we were the stalking horse bidder in the bankruptcy proceedings, we added over 100,000 new bed and bath related products. So we knew that we had some headwind with suppliers, and this just proved it out as people came to us and said, we'd love to be a supplier and help you with these products that you're going to need and want.
We've got drawers full of coupons. Do you keep the coupons? Is that something that customers should still expect to come forward?
So Bed Bath & Beyond has been a high-low retailer. The coupons are so important. Overstock also is a couponer. One thing I think you'll see us initially do is be aggressive on coupons as we reach out to these customers. But I would note that our pricing has been a little bit different than Bed Bath & Beyond. I think the Bed Bath & Beyond customer will want the coupon, but will also find that our pricing beats the Bed Bath & Beyond historical non-couponed price. So yes, we will provide coupons, probably start out strong like Bed Bath was used to, but they won't be quite as big as we move forward.
And the loyalty program that you mentioned that was so popular?
So we have our Club O loyalty program. We'll be morphing that into the welcome rewards. All the benefits of Club O will come with it. We're reaching out to the welcome rewards participants. We want to make sure they're there. We think our new loyalty program expanded will be even better than what either provided before.
Within retail, I mean, home, appliances, and some of the toy categories, they've been sitting in a lull right at this point in time. So have you seen any type of bounce back, any concerted attention even in searches among consumers right now?
Still a tough macro environment, particularly for our category. I mean, I know earlier in the show you were talking about interest rates and slower home sales. That certainly hurts us. I do think it was important that we maintained and continue to maintain a strong balance sheet, because it's in environments like this that opportunities arise, and this allowed us to jump on that opportunity and take advantage. I think we're going to perform well even while the macro is hard for the industry.
On the conference call, or I guess in preparation for the conference call today, you put out sort of the recipe for how this is going to work, bringing together what you see as the strengths of each of these brands here. The same time you made this announcement that you were acquiring the IP and changing the name of the website, you also said that your second quarter sales likely fell 20% year over year. How soon does that change? How soon do you see sales actually rising year over year? And does this name change accelerate that timeline?
So our deceleration in sales is slowing. It's not where we want it to be. We'll talk more about the second quarter when we release our numbers. I think this has to help. It will help with top line. It will ultimately help with bottom line. But as I noted on the call today, we'll spend the next few quarters probably deviating from our standard marketing practices and going a little bit harder as we reach out to these new customers. We'll have a good sense. You mentioned in the opening that Canada is first. We actually launched our bedbathandbeyond.ca site this morning. Closed the deal yesterday, launched that site this morning. Crisp, clean. We think we'll learn a lot in the next weeks and be ready to launch strong in the US early August.
I'm going to have to get my sister in Canada to check, in Vancouver, to check that out and give me back a report. Are you going to change the corporate name of Overstock?
Early days, we just finished this acquisition. I expect we will in the coming months, but we want to make sure we get the operations right and focus on that before we do some of this corporate work.
Is there a leading candidate as you're tossing around ideas, even at the table?
Not yet. We'll look at a lot of different things. We've acquired a lot of different names as part of the Bed Bath & Beyond IP. We've got thoughts of where the company will go in the future. We'll be careful, but we will do business as Bed Bath & Beyond because that's the iconic brand that Americans loved and we're glad to be saving.
Even just lastly here, as we think about the credit state for a lot of companies in retail that have tried to make sure that they are still in good standing with their suppliers, how would you evaluate that? How would you say that Overstock's credit state currently sits?
So our suppliers love doing business with us because we have this healthy balance sheet. We ended the first quarter of this year with about $375 million in the bank. Allowed us to do this deal all cash, which made a difference in the bankruptcy proceeding. I know a lot of suppliers, their asset-backed lenders or their factors worry who they sell to. They have no worries with us. So we feel like we have this strong balance sheet that makes a difference in a lot of ways, lets us play offense with suppliers and when opportunities like this arise.
Jonathan, thanks so much for taking the time coming here in studio. We can't wait to hear more to come on this major IP acquisition. Jonathan Johnson, who is, of course, the Overstock CEO. Thanks so much.
Brad, Julie, thanks for having me.
Thank you.
Good to see you. Well, with inflation still weighing on Americans' wallets, the White House is working to promote the broader economic message. Jarrett Bernstein, who is the chair of the White House Council of Economic Advisors, joined Shauna Smith and Jared Blickery on the 3 to 5 show yesterday. Here's what he had to say.
He's framing out this idea of Bidenomics, which is building the economy from the middle out and the bottom up. And he's making a stark contrast between that and top-down or trickle-down economics, the failed idea that if you just cut taxes for rich people, that's going to somehow uplift the middle class, against decades of evidence that it just doesn't work that way. How does it work? Well, the 3 pillars of Bidenomics are reinvesting in America, reversing years of disinvestment in our public goods in a way that crowds in hundreds of billions of investment from the private sector, promoting more competition, both to lower costs and to give small businesses a fair shake, and empowering and educating our workforce. Put those together and you have a strong recipe for continuing some of the positive growth that we've seen thus far and continuing to make progress against inflation.
Chair Bernstein, it's great to see you here, Shauna. But what stuck out to me a couple of things stuck out to me in this speech. Well, one thing that did stick out to me was when the president said that he wasn't declaring victory yet. And I bring this up because from your perspective, as one of the top economic advisors to the president, what do you view as one of the biggest dangers to the economy, and how are you what's your plan just in terms of how you plan to work to address that?
Well, look, this is an economy, as I'm sure you've had in many discussions, that has some real headwinds. We obviously had some challenges in the banking sector, so important for credit flows. We have a hiking cycle. We have inflation that has come down significantly but needs to come down more. But also, some really important tailwinds. And I think too often people maybe don't get that balance quite right, especially those who look around and say we're in some kind of a recession. I don't think the data support that at all. And in fact, I think if you look at the recessionary indicators, they're all pretty clearly in a non-recessionary place. But if you look at a virtuous cycle between a tight labor market generating wage gains, generating consumer spending, which of course is almost 70% of nominal GDP, it becomes a little bit less of a mystery why we keep having this positive cycle, why we keep having job gain months that beat the forecast, I think 14 or 15 months in a row. So that kind of virtuous cycle is a real tailwind. There's also headwinds, and that's just the way it is right now. We have to, we have to be mindful of both of those forces.
And we heard from Fed Chair Jerome Powell earlier today, once again reiterating that 2 rate hikes could be necessary at this point in order to get inflation under control. You just mentioned the strong jobs market. If we do see 2 more rate hikes and consecutive at that, Powell saying that that's on the table, what do you think that is going to do to the labor market?
Well, I think without getting into any granular critique of Federal Reserve policy, which I think one of the more important things we can continue to do to help inflation ease is make sure the Fed has the independence they need to do what they have to keep doing, what they have to do. I think it's important for us to recognize that Pillar 2, particularly today, Pillar 2 of Bidenomics is making sure we have an empowered and educated workforce. Now, what does that mean? When we talk about worker empowerment, one of the things we're talking about is the tightest job market in decades. Unemployment below 4% for a year and a half. Now that's the overall number, but we know that that means particularly low employment for groups that are far too often left behind. And that's something this president is acutely aware of. The importance of tight labor markets, he talked about it today under the rubric of full employment. The importance of tight labor markets to give workers a little bit more bargaining clout. That's also why he's one of the world's most pro-union presidents we've seen. Now, add that to educating our workforce so that we can complement things like our CHIPS program, where we're incentivizing significant investment in that sector, standing up a domestic semiconductor industry, and you're helping to build out the economy's supply side, in this case, labor supply, but also chips and infrastructure. Building out the economy's supply side, its capacity, puts medium and long-term downward pressure on inflation.
Jared, while we have time here, I just wanted to bring up the fact you were recently promoted to the chair of the Council of Economic Advisors. What does the Council of Economic Advisors look like right now, and what kind of transition, if any, has it been undergoing?
Well, what it looks like is a staff of about 30 junior and senior economists who are some of the best economists in the country who come to CEA to help serve this president and his vision of Bidenomics. And we continue to do what we've been doing, which is provide the president and the senior staff with up-to-date analysis information on the data flow, much of the same kind of things you talk about here. Try to look around the corners and see where those headwinds and tailwinds I just talked about are taking us. Of course, every year we write the economic report of the president. And look, at the White House, we're very much involved. The CEA is very much involved in our policy processes as well as we think through how to best implement our investments in clean energy and electric vehicles and semiconductors, making sure that the economy stays on track at the same time that we're building from the bottom up and the middle out, very much in the spirit of Bidenomics.
You mentioned the investment that the Biden administration has done with the CHIPS Act. Obviously, chips being a priority, bringing manufacturing to the U.S., a massive priority here for the Biden administration. There was also a report from the Journal this week just that we could see more crackdowns on exports to China of those chips. I'm curious from your perspective, the economic implications, if any, of these wider crackdowns. Do you see any from that?
Well, certainly one of the values of the legislation that we've been talking about, whether it's the CHIPS Act, the Inflation Reduction Act, or the bipartisan infrastructure law, is learning a critical lesson from the pandemic about the importance of resilient supply chains. Now, look, inputs, intermediate goods flowing here from abroad, that's still going to be part of our economic model, of course. I mean, if you just look at battery production, yes, we're very interested and full speed ahead in terms of developing EV and battery production here in the United States. But some of those materials are going to come from abroad because that's where they exist under the ground. So I think we're going to have to both be mindful of the importance of our trade flows while we really implement one of the insights of this president in this space, which is that for years, trade policy was built over the concept that workers, that Americans are solely consumers and not workers. That as long as we think about cheap goods, Americans as consumers, fine. But look, if trade policy is hollowing out a community, if it's shipping jobs overseas, if our system incentivizes manufacturers going abroad, that is not something that's okay with this president. That is antithetical to Bidenomics, to investing here.
Let's take a final check of the markets now. We started the day off not much changed, and we haven't gone too far since then. The Dow is now up about 130 points. The Nasdaq is down about 25 points, or about a fifth of 1%. And the S&P 500 is barely changed at all. What's going on with the sectors, Brad? I see you looking at them on your Yahoo Finance page.
Yeah, communication services, the worst performer here on the day. Best performer, though, financials. That's holding up after the banking stress test results that came forward. Well, that's it. Stay tuned. We've got more. Yahoo Finance. Michelle Akufo's got you for the next hour of trade.
What is a vibe session?
I didn't coin this term.
Okay.
But it's basically a recession that comes with lower consumer confidence, but where Americans don't act on it. They don't cut their spending.
So is it actually a recession?
Sort of. Sort of. It doesn't feel great, but it's where your pocketbook really isn't affected. It's just when things around you don't feel good.
And is that happening?
Not right now.
Okay.
I actually think confidence is up, but it happened last year.
Okay, got it.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. The Supreme Court shuts down affirmative action at colleges, banning schools from considering race during the admissions process. We'll discuss the potential wider impact. And changing times. Are media companies becoming less consumed with exclusive content? We'll tune into what this could mean for the future of streaming. And coming to the market, another IPO on tap today. We'll speak to the CEO of Savers Value Village following the thrift store's public debut as it looks to capitalize on the second-hand fad. But first, let's take a look at the major indices, see how they're faring at the moment. Looking at a mixed picture here, we see the Dow here now up about 138 points, sort of trading in a middle range so far, up 0.4%. The S&P 500, they're also up just barely, though, by about 5 points. We're seeing financials leading the way on the S&P after those banking stress test results. Tech-heavy Nasdaq there, down about 20 points there. The FANG stocks weighing on the Nasdaq, except for Apple, one of the only outliers there. Let's also check in on the Treasury market. We're seeing some of the recession talk getting pushed out further into 2024. We're seeing the 5-year just up there about 4%, the 10-year also up about 3.7%, and looking at the 30-year, that's up 2.7%. Well, the Supreme Court has shut down affirmative action at colleges, banning schools from considering race during the admissions process. The ruling stated that Harvard University and UNC's policies go against the Constitution. Yahoo Finance's Alexis Keenan joins us now with the details. Hey, Alexis.
Hi, Rochelle. This is just such a huge ruling, and it's such a sweeping change for how colleges do go through the admissions process in the United States. Now, the question in this case was, can public universities, private universities consider race when they're looking at applicants in college admissions? And the answer in a 6-3 ruling down ideological lines was no. The majority writing that Harvard and UNC's admissions programs violate the Equal Protection Clause of the 14th Amendment that says no state shall deny any person within its jurisdiction equal protection of the laws. Now, those laws across states, they generally bar governments from race-based discrimination. So that's kind of how the pieces fit together in this case. Now, dissenting in this, in both cases, Sotomayor, Justice Kagan, Justice Jackson, all dissenting. Also, Justice Jackson having had recused herself from the Harvard case because she is an alumna of the school. Now, this impacts arguably all college applicants in some way, whether they're a minority or not. Today, approximately 40% of U.S. universities do use race in their admissions process. Now, in both of these cases, the plaintiffs were the same. They are the Students for Fair Admissions. And they argued that the plaintiffs, they were saying that race should not be used any longer because they said that Asian American applicants were being discriminated against to their detriment, and that it was finding that it was less likely that they would be admitted to college universities than similarly situated and qualified white, Black, and Hispanic students, as well as Asian students there. So this case, though, it overturns just a long line of cases in the United States, going all the way back to Brown versus Board of Education, which overturned separate classroom atmospheres for students based on race. But more particularly, there's a 2003 case called Grutter v. Bollinger, and that okayed the use of race, and that was a University of Michigan case, the law school in that case. And they said that the justices at that time in 2003 ruled that it's okay so long as race is one narrow factor among a lot of factors that are included when considering college applicants. But really tellingly, back at that time, Justice Sandra Day O'Connor, a Reagan appointee, she was the swing vote in that case. She penned the majority in that case, and she predicted that after 25 years, affirmative action would no longer be necessary to make colleges more diverse, though certainly still a debatable issue still today, whether this was the timing for this or not. That is going to be, I'm sure, hotly contested here.
Indeed, because I know a lot of people have concerns, questions about what this means for the pipeline of talent who are able to access college and perhaps enter the workforce. So then, could this have any wider implications beyond the universities?
Yeah, and you hit on it right there, Rochelle. This is a case where amicus briefs, those are front of the court briefs, where they're submitted on one side or the other. These two cases, I keep calling it one case, but it's two cases, Harvard and the University of North Carolina. We had Apple, GM, Starbucks, and approximately 40 major U.S. corporations all siding with the idea that affirmative action is still a good practice and should be constitutional because of that pipeline. They say that they're able to hire out of a pool of more diverse candidates as college graduates if these practices stay in place. So definitely had so many corporate actors wanting this to turn out a different way today, though. Writing in the majority, the Chief Justice John Roberts wrote this when he said, eliminating racial discrimination means eliminating all of it. Rochelle?
I appreciate you giving us that update, our very own Alexis Keenan there. Well, it's a busy week for the Supreme Court. Federal student loan debt is coming due once again. After 3 years without that expense, starting in October, over 40 million Americans will have to start making those payments again. This added cost expected to eat into consumer spending for younger generations. Our next guest sees student debt as a possible contributor to weakening economic conditions later this year. Joining us now is Marvin Lowe, State Street Senior Global Macro Strategist. Thank you for joining us. So for people who are trying to connect the dots between student loan debt and the economic implications, how might we see that play out?
Yeah, for certain. So, really what's propped up the economy and surprised pretty much all the economists, myself included to a certain degree, is how strong the consumer's been. And that consumer is strong because of the jobs market, but also because of the amount of savings that were accumulated during the pandemic. On average, it's about $300 to $400 a month for those 40 million people who have not needed to make student loan payments for the last few years, like you mentioned, and that starts up in the next couple of months. So that certainly will eat into some of the discretionary spending, but also with defaults increasing, at least along the margin, in the groups that have the most outstanding student debt, kind of per capita, if you will. You put all that together, and it certainly is going to be a headwind for this better economic story that seems to be evolving as we get into the middle of the year.
And what about small businesses? A lot of them sort of bootstrap their way into the market here. What could this mean for them?
I'm sorry, what was the question?
For the extra capital that people could use to start a business, especially for some of these, smaller businesses that have to bootstrap, what could the implications be there?
Yeah, absolutely. So, there's a series of things coming together, and causes us a great deal of concern as we go into the fall. Those small businesses do rely on smaller regional banks. They rely on kind of the more Main Street lending types of institutions, and we've seen what's happened to a lot of these banks since the March banking strains. We really haven't heard much about it as of late, but those deposits are still hard for those banks to get. And if they can't get deposits and the deposit base is jittery in terms of pulling out assets, then you wind up in an environment where credit gets tight. And it's one of the things that we're looking at as, again, another headwind to this kind of economic story as it evolves.
So let's talk about how investors are reacting. Obviously, you have tighter lending conditions, keeping an eye on regional banks, but you also have a hawkish Fed that's in skip mode, perhaps telegraphing 2 more rate hikes this year. I mean, what is all this doing for investor appetite?
Yeah, for sure. So at State Street, we have an institutional investor indicator. Gives us a sense of what the institutional investor is doing, and they're quite defensive. We're seeing more allocation into cash. We're seeing an overall defensive posture, which has less exposure to commodities, less exposure to cyclical stocks. So, we do see kind of that investor group, if you will, putting up walls to protect themselves from a recessionary kind of environment.
And how are they positioning themselves with equities versus bonds? They're trying to sort of be defensive, but also trying not to miss out on some of the rallies that we've seen.
Yeah, for certain. So, we are seeing that cash allocation increase. So it's higher than kind of longer term averages, if you will. So there's been a noticeable amount of money that's gone into this cash category because ultimately, the yields that you get at the short end of the curve is pretty attractive. A lot of that reallocation is coming from the equity market. So there is less exposure to equities overall. And I would say kind of within the exposure, there definitely is more of a quality bias as well as this kind of quality growth, which tech kind of fits into to a certain degree. So we are seeing those types of trends continue, but certainly girding for some economic headwinds that might be coming.
And are you seeing more of a broadening? Obviously, tech was leading the rally to this point. Are you seeing sort of branching out into other aspects of equities beyond tech?
Yeah, not really. It's the quality names and the quality sectors going into an environment that slows down. So healthcare for certain becomes a very interesting type of discussion. They have a lot of barriers to entry the way tech has barriers to entry. And again, kind of the quality growth that comes out of tech, that comes out of the balance sheets, that comes out of the cash that ultimately a lot of these companies are able to generate. That is an attractive quality for investors these days.
And we're taking a look at Treasury yields. We saw those rising on better than expected revised annual Q1 GDP data. Also looking at that inversion on the yield curve continuing to widen. What is that signaling about what's ahead?
Yeah, I mean, it's a market that's taking what Chair Powell said yesterday more seriously today. There was data that came out that indicates the economy is still stronger than people expected. So you can get some upside surprises. A higher Treasury yield, particularly the way it's trading is today, is one where we think that the Fed might hike again later this year. If they do go in July, we might have another one after that. But really a higher for longer kind of environment, which pushes the curve into a more inverted position. And then ultimately, in my mind, it's signaling that you are going to have a recession. The further inverted you get, the more likely the recession odds emerge from that curve.
And obviously, we're still continuing to get data in, getting inflation data in. Yes. Is it a sense that markets are pushing recession risk out, or are they sort of overlooking it and just thinking maybe it's just not going to be as bad as they think?
Yeah, it depends. It depends on the type of investor. Certainly we've all watched equities, and some of us have scratched our head given how strong the rally has been. It's been narrow, but certainly those are real gains. I think that from that perspective, there is a view either that you're pushing out recession much further out or even ignoring it. Other markets like risk asset, like the Treasury curve, like some of the other fixed income categories are certainly signaling recession, and really the amount of money that's moving into the cash part of the discussion is also showing a concern that ultimately has a little bit of a recession marker within that behavior.
I do thank you for joining me this morning with your insights. Marvin Lowe, State Street Senior Global Macro Strategist. Thanks so much.
Thank you.
All right, looking at drama between Florida Governor Ron DeSantis and Walt Disney could be put on hold. DeSantis is pushing to delay the trial until after the presidential election. Joining us now with more on this is Yahoo Finance reporter Rick Newman. So, Rick, what do we know so far?
Well, there are two things going on here. There's a litigation in state court where the local residential district wants to seize control back from Disney. But this is the federal lawsuit. Disney actually sued DeSantis and the state of Florida, saying that this was political motivation that led to them trying to take Disney's municipal control, which happened last year. So Disney wants this trial to start in July of 2024, which, guess what, would be smack in the home stretch of the presidential campaign. And that's actually the month that the Republicans will have their nominating convention. And of course, Governor DeSantis wants to be the nominee. He's running for president. DeSantis answered that motion saying, no, let's move this to 2025, which obviously would be after the election. So Disney has rolled up its sleeves on this, and it's playing hardball. And the net result, if this does actually go to trial and doesn't settle, is that DeSantis is going to have to be explaining this to voters. Why is he in this lawsuit with the Walt Disney Corporation, which is a pretty popular U.S. brand? What is this all about? And this is, potentially this is going to be quite a shadow that hangs over his campaign, assuming he's still in it in the home stretch of the primaries next year.
Certainly feels like a long way away, but still a lot happening with all these moving timelines for lawsuits. Rick Newman, thanks so much for that update. Right, well, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
Most people we talk to, right, are in the Wall Street orbit. You're in North Carolina. Do things feel different there from a recession perspective?
Yes. And I'll tell you, Charlotte is growing very quickly. People are coming back to the office. We have a lot of big banks down in Charlotte, and the housing market is crazy. It's hard to look at what's happening in uptown Charlotte and say that we're in a recession.
Retirement insecurity has become a real issue to navigate. Inflation in grocery stores, health insurance, and worries about social security funds running out. I mean, those are just some of the worries that adults are thinking about when they're retiring and are trying to consider them. Now, data from Advisors Capital Management says more than half of retirees only rely on social security, and that more than 50% of people are unprepared for retirement. Let's bring in Kerry Cabanaro, Advisors Capital Management, Senior Vice President and Director of Women and Health, to talk some more about this data. Good to see you here on the show.
Thank you.
Pretty disturbing data that we're seeing about how unprepared people are. Why are they so unprepared? What's happening here?
There's so many reasons. Let's go back to 1978. 1978 is when 401ks came into play. And that's when the government shifted the onus, or really the employers shifted the onus from the employers to the employees and said, we're not doing pensions anymore, now you're responsible. So that's when 401ks started. And literally the numbers went like this for 401ks and like this for pensions. And so now there's nobody has pensions, and that's a big reason for retirement insecurity. And then also the fact that not everybody's saving in their 401ks. So there's so much more to that, but I'm going to ask my next question.
Okay, so we're coming up on July, which is National Retirement Month here. In terms of steps that people can take to see how prepared they are, see how much money they're actually going to need to be able to not just sort of survive during retirement, but actually enjoy their life. How should they be looking at this?
Okay, so I tell everybody, I want them to save literally as much as they possibly can, right? So the most you can save is what you should be putting away. I always tell people that they should be maxing out their 401ks, right? And if you can't max it out, start somewhere. It doesn't matter if you start small and then you up it every single year, even 1%, 1%, 1%, 1%, and before you know it, you'll be maxing out. And if people are at least maxing out their 401ks, that's a really great start for retirement, because, you know, we do have the retirement insecurity of Social Security, which, you know, believe it or not, more than half of Americans are actually relying on Social Security for their retirement, which I don't know how they're living on that, because it's really not enough, especially with what's going on with, you know, double-digit inflation, which we haven't seen since the 80s. So if you're relying on Social Security, you need to not rely on it, because you need to have other savings like retirement savings and also outside savings. So I say the more you can save, the better. And you really need to start, you know, tightening your budget, look at your budget, know your numbers, what's coming in, what's going out, so you can figure out how to get some extra money within that budget.
And so how should you think about sort of resetting as you're sort of in your 20s versus your 30s, your 40s, and then closest to retirement?
So in your 20s, it's so funny because you have so much time till retirement, right? So you're in your 20s, you're maybe retiring in your 60s. So that's, 40 something years. Start now. It's the best time because you've got all that time to grow your money. And you don't even feel it. I remember my stepson said to me when he first got his first paycheck, and he said, I can't afford to put in money in my 401k. And I said, you can't afford not to put money in your 401k. I will kill you. And so he did his 3%, and then he upped it every year. And then by the time he was in his 30s, he has a 6-figure nest egg. And that's what happens. It's just literally a matter of setting it and forgetting it with your retirement savings. So that's what you should start in your 20s. So, and when you're in your 30s, same thing. Obviously, you might have more priorities because you have, more things pulling at you, like, home, children, but you still have to find that money for a retirement. And what happens is once you start saving and you have it on autopilot, you don't even miss it because it's just automatically happening. And it's just behavioral finance where it just happens and it's just all of a sudden it's building and building and building over time. Now, of course, in your 20s and 30s, you also have to be invested in the stock market and, not keeping it in cash or bonds or something safer, because you really need to be a higher risk allocation when you're younger. And, as you get older, you kind of just pare it down over time. But it's a great thing. You have 40 years to go to save for retirement. And then you're going to be in retirement for 40 years. So that's what I always tell people. You got 40 years to save for 40 years after.
Maybe I should threaten my 9-year-old. Maybe that's the way to get her to start taking her saving more seriously. I do want to ask you, though, in terms of like a lifetime of earning potential, drastically different for men than it is for women. What should they sort of be factoring in extra when they're trying to plan for retirement?
So it's so interesting. I'm so glad you asked me that question. So, women have so many strikes against them when it comes to retirement because they earn less, they make less. They've got, because of the pay wage gap. They're out of the workforce because of caregiving and either having children or taking care of, parents. So there's so many issues, and women live longer. So, you've got all these strikes against you, and women are less likely to be invested in the stock market because they think it's risky. So what I tell women is you need more money, not less money. You need to save so much more than you think you need to save, and you really need to get with a certified financial planner who can really give you a guide map and roadmap for your financial future to get you where you want to go. And because you're going to live so long that we outlive the men. And so I want you to be able to have a great retirement, women. So please start saving.
Definitely. And I do want to ask you, because depending on where you live, I mean, your taxes are different. And I mean, some of the data shows best and worst places to live for retirement. Virginia, Florida, Colorado topping the list among some of the worst, Mississippi, New Jersey, Kentucky. Should people be thinking about either relocating, or how should they be viewing where they live in terms of how they retire? What sort of things should be on that checklist?
It's so important. I tell people all the time, you know, it's not what you make, it's what you keep. So if you are in a high tax state, you are paying for that. And I can actually run with my clients, we run calculations. What if you moved to Florida? What if you moved here? What if you left, you know, New York and New Jersey? What is it gonna look like? How much is that gonna add to your net worth over your lifetime? And obviously, you know, with remote work, it's definitely helping things way more than it has in the past. But it's a big calculation of a choice of where you're going to live. It can mean millions and millions of dollars for your net worth.
And for people who are trying to balance, you know, they have inflation concerns, they're trying to save, trying to pay off debt, retirement for some people can just seem like the last thing they even want to be thinking of as a priority. What message would you tell them?
I would tell them, you cannot borrow for retirement. Think about that, right? You can borrow for current needs, you can borrow for future needs, you can borrow for your house, you can borrow for college. You can't borrow for retirement. So it is up to you to save. And then as far as Social Security goes, you know, the current numbers are that, you know, Social Security is going to be bankrupt by 2033, which is pretty scary because it's not that far away. And obviously things need to change there because we're going to have to keep upping the retirement age, and the payments are going to get, you know, lower and lower. And I know that they were high this year because of the COLA, because of inflation, but that's not going to continue, we hope. And you have to own your own financial future, because I don't think the government's going to take care of it for you. You all need to own it for yourselves.
Certainly lots of great insights, very helpful tips there as well. A big thank you there to Advisors Capital Management Senior Vice President and Director of Women and Wealth, Kerry Carbonaro. Great having you on.
Thank you so much.
All right, we still have all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
Do we think a recession will happen this year?
So we don't know, but we know that expectations seem to keep getting pushed further and further out. And one of the things that I wrote about this week was a note from Credit Suisse that says the recession won't actually start until the yield curve uninverts. And right now, futures don't put that until 2026, which is pretty incredible. We'll see.
I'm going to say no. I'm going to step out and say no. You know, the economy's been stronger than we thought, and I think we can push it out another 6 months.
As we approach the end of the second quarter, the market suggests that the Nasdaq could add to its 6-month tally in the back of the year. Let's bring in Yahoo Finance's Jared Blickery to discuss more. Hey, Jared.
Hey there, Rochelle. I think investors would salivate if they get anything approaching these returns. This is the first half of the year, to date, in the S&P 500 sectors. Tech, communication services, and consumer discretionary all up about 30% or more. That's an incredible run, as we've been talking about. But is it sustainable? I went back to the history of the Nasdaq, going back to its beginning in early 1970s, and I found two examples of years that were up more in the first 6 months of the year. However, they gave back substantial portions in the second half. This right here shows the first half of the year in blue and the second half in red. And indeed, in 1975 and 1983, we did give back a substantial amount of profits. Same thing for here, 1990, it looks like 1990, 86, and also 87. And what happens here? Why do some years look better than others? A quick example. This isn't going to be representative of all years, but here's a market that ran away from itself, got ahead of itself. You can see it's from the lower left to the upper right. This is 1986. That blue line is a 10-day moving average, very closely hugging it all the way up. What happened in the second half of the year? Gave back a lot of those profits. Here's another example, but this one in 2019, we had a correction. We had a little bit of a modest correction here, kind of trading sideways for a while. That gave the market some ability to pause and head higher. You can argue, yeah, it's a function of timing. The beginning of the year happened right after that huge plunge at the end of 2018, but a lot of years look very similar to these two. So I want to go back to the present. I was just showing you our heat map of the year to date. Now I'm going to show you quarter to date. And remember, these three sectors right here, the mega cap sectors, and here's quarter to date. You can see the same sectors represented here, but when you drill it down to the monthly level, and it's within the last month that the rally really broadened out, that we see participation from more sectors. XLY is consumer discretionary. That was there in the other two, in the month to date, in the quarter to date and year to date. That includes retail names. So it's not just Amazon. That particular large cap is a part of it, but we see industrials, materials, those are also outperforming. Financials, tech adding to some of those gains. So we really did see the rally broaden out, and those are the sectors I want to follow going forward to see if we're going to rotate back and forth between maybe these mega caps and some of these other sectors.
All right, thanks so much, our very own Jared Blickery there. Right, well, I'm watching shares of Virgin Galactic right now. Its first commercial spaceflight just took off. Taking a look here, 3 scientific experts are on their way to the edge of space. The crew includes 2 Italian Air Force officers and an aerospace engineer from the National Research Council of Italy. They boarded the ship and headed to the edge of space. You can see some fantastic shots there. The mission is meant to be more scientific, with the 3 men planning to collect some biometric data, measure cognitive performance, and record how certain liquids and solids mix in microgravity conditions. Virgin Galactic stock has been under pressure since its first test mission featuring billionaire founder Richard Branson. That was 2 years ago. And if this mission goes well, the company could be back on track to complete trips with paying guests. They have said that those tickets will cost anywhere from $250,000 to $450,000. You're looking at some incredible live pictures there right now. All right, well, speaking of another founder here, on Tuesday, Volvo announced that it would be the latest car company to join Tesla's charging network, following in the tire tracks of Ford, General Motors, and Rivian. But Wall Street is keeping a close eye on the EV leader after some bearish calls. You see a series of recent downgrades of the stock begs the question about Tesla's current valuation and what these partnerships could mean long-term for the company. Let's get another take from Roth Capital Partners senior research analyst Craig Irwin. Craig, good to have you on the show here. So what do you make of what we've seen here with a lot of these downgrades, but still seeing these raised price targets?
Well, what's going on is that the stock has performed incredibly well this year. There was a very tough ending to last year. They cut prices. And those price cuts were successful in reinvigorating enthusiasm on the sales side. And then you layer in the success of NACS, the Tesla charging protocol standard connector, being adopted by many of the leading OEMs. So, they've had some real wins, and the valuation has taken off like a kite, from close to $100 to, 250 plus is a big move. So, people are, I believe, just really being reactionary. I've maintained my long-term bearish stance. It's a great company. They played a huge role in transforming transportation, but you've got 100 new EVs coming to market. These big names you mentioned, Ford and General Motors. There's lots of old guard that's coming in with pretty compelling vehicles that I think is going to compete effectively and make it harder for Tesla to see the growth and the margins that they've been achieving going forward.
And I mean, at least for now, Tesla is still dominating versus some of the other EV makers out there. So how sustainable, though, is the demand side of the picture? As you mentioned, there are so many more people coming into the fray with potentially cheaper models, too.
Yeah, so what's been proven out, actually, is that demand is really price sensitive. So Tesla's cut certain models as much as 30%. So, consumers respond, when there's big price changes, they do respond. EVs have been expensive because batteries have been expensive. There's been a lot of progress bringing down battery costs, but the capabilities really haven't been improving as quickly as people had hoped. As these things make progress over the next many years, it's inevitable. You're going to see continued fantastic adoption of electric vehicles. But demand is weak. Demand is a little choppy in this environment, which is why Tesla had to go out there and cut prices as aggressively as it did.
And so how do you think sort of getting more partners on board with the supercharging network and that infrastructure and the revenue that might come from that, does that put it perhaps in put a bigger moat around it, I suppose?
Yeah, so they have been roughly 80% of the North American market, dominating globally, and deserve full credit for that. A large part of that success was actually the supercharger network. The Tesla drivers charge on average about 15% of their miles driven on DC fast chargers, on these superchargers. The rest of the EV drivers in North America do about 5%. So their network is something that gives their customers a lot of comfort. So, it's also, a multiple of the size of everybody else's networks, the private networks. So General Motors and Ford and everybody else jumping in and signing these agreements to gain access to that is very positive for them, positive for adoption. We don't know how much their customers are actually going to end up paying versus Tesla customers. And, I think there is some potential impact to the Tesla brand. You're not really going to be enthusiastic sitting online to charge your vehicle behind a great big Hummer. It's going to take 2-3 times as long to fill the battery. So, there's pluses and minuses. They probably do make some money on this, and that's a fantastic thing. That's what capitalism is about. That's what drives investment. But I look at Tesla, I say it's egregiously overvalued, but man, what a fantastic pioneer to drive this industry forward.
I mean, and speaking of pioneering, we have to talk AI here. A lot of big bets coming from the AI side when, Elon Musk talked about, buying more chips from NVIDIA and really trying to get ahead of this. How much of that is also factoring into the fervor, and how much of that is sort of well-founded at this point?
Yes, so the institutional investors usually take that with a grain of salt. I mean, they trade it like retail investors. So there's, retail is a very large part of the trading and trading direction, trading velocity in the stock. But the big institutions all know that, on a relative basis, the importance of AI to Tesla is moderate. The full self-driving capabilities are really a misnomer in my opinion. When you look at the rate of these false stops, the aberrations, when you're driving these vehicles, 1 to 4 or 5 a mile, and you think about those actually causing accidents, it's beautiful that they're pushing hard to develop the technology. I just think that others will be more careful in introducing things into the market. And, Tesla's going to make other people go faster, but the profit opportunity from this AI, I think, is much more limited for Tesla, at least at the moment.
So then when you're comparing sort of the near-term uncertainty versus longer term, would you say this is more of a bull run or a bull trap? How should investors be looking at this?
It's definitely not a value trap. Maybe a bull trap is the right label. A lot of investors trade as momentum investors and are in this stock, and correctly selling into strength, in my opinion. And then buying on weakness. I'm not against that kind of trading strategy. I do think that if some of these concerns about the battery source for the rear-wheel drive Model 3, their highest volume vehicle, switching away from a Chinese source, that's a question mark. The impact of competition. Some of these other networks quite probably do better on a relative basis on the charging side than Tesla, given Mr. Musk's political posturing. A lot of investors are acutely aware of this and watching closely. And as this evidence comes out, you can expect, some significant volatility in the stock. Goes up quickly, will go down equally as quickly, and we're cautious. We think people should be aware that that's a significant possibility, over the next number of months.
We'll certainly be tracking that. Great having you on. Roth Capital Partners Senior Research Analyst Craig Owen. Good to see you.
Thank you.
All right, we still have all your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
What is a vibe session?
I didn't coin this term.
Okay.
But it's basically a recession that comes with lower consumer confidence, but where Americans don't act on it. They don't cut their spending.
So is it actually a recession?
Sort of. Sort of. It doesn't feel great, but it's where your pocketbook really isn't affected. It's just when things around you don't feel good.
And is that happening?
Not right now.
Okay.
I actually think confidence is up, but it happened last year.
Okay, got it.
The media industry has had its fair share of pressure this year. Taking a look here, streaming companies are slashing costs to account for soft ad spending and even cutting jobs as threats of a potential recession loom. Let's not forget to mention the Hollywood writers' strike, which has made matters worse by delaying content for consumers. So with all this uncertainty in streaming, what can we expect for the second half of the year? Well, let's bring in Kevin Tran, Morning Consult media and entertainment analyst, to weigh in on all of this. Good to see you. Obviously, a lot going on here. So I want to try and figure out what phase we're now entering for some of these streamers here. It used to be about exclusive, expensive content. What happens now?
Right. And first off, thanks so much for having me. I think what you laid out is good context. And um, in the beginning portion of the streaming wars that started in late 2019, like you said, there's a big emphasis on flashy content having as much shows and movies as possible. Now, with the emphasis on profitability, we're seeing companies actually lighten their libraries and look for more licensing opportunities to increase revenue and not have to pay residuals on titles that aren't getting as much viewership. So I would expect that trend to continue, as well as on the creator side with big names. I would expect these big studios to be a little more choosy on who they're signing to longer term deals with high dollar values attached.
And obviously, it's all about getting, eyeballs from consumers and that ad spend as well. What are you seeing, though, in terms of ad spend? When you look at ad-supported tiers versus ad-free, who are the real big winners here, and what are they doing right?
Yeah, I would say in general, a lot of people so far are focused on ad free tiers, but we're seeing more of an emphasis by consumers being placed on the cheaper ad supported tiers. So our data shows that around a third of consumers say that most of their streaming subscriptions are ad supported. And I would expect this to increase as the year goes on. I think there's just a lot of consumers so far who still aren't aware that streamers like Netflix and Disney Plus have recently launched cheaper ad-supported tiers. But as the streaming landscape as a whole continues to raise prices for ad-free tiers, I would expect more consumers to reevaluate their budgets and, as a result, become more aware of the cheaper ad-supported tiers that Disney Plus and other streamers are offering.
And speaking of Disney, I mean, we have to talk live sports because that's meant to be a sort of next bastion that everyone's trying to fight for, trying to get a piece of it, but also very, very expensive. How do you see that playing out? And does the consumer demand justify some of the costs?
Yeah, I think there's definitely a lot of interesting sports rights deals going up for auction over the next couple of years, the NBA being one of them. I think that Disney will be very smart in terms of what it chooses to lock down. Our data shows that when it comes to Gen Z consumers, which of course a lot of streamers are focused on, they actually lag all US adults in terms of interest in sports in general and a lot of the major leagues, such as the NFL. So I think that it comes down to not only knowing which specific leagues the Gen Z viewer is more interested in, which our data shows that the NBA tends to be a league that uniquely skews towards Gen Z, will be something that media companies like Disney should consider. And part of that is how these leagues are able to broadcast themselves on social. TikTok, for example, we know is a uniquely Gen Z social network. And as of late this month, the NBA's following on TikTok was around double that of the NFL's and higher than that of leagues such as the NHL and the MLB. So taking factors like that into consideration will really help these streamers make informed decisions on where to lock down sports rights.
And we have a lot of summer blockbusters coming out. Some people are like, I'll just wait till it comes on streaming. Look at some of the blockbusters. We have Barbie, you have Indiana Jones coming out. Where are some of these companies trying to put their ad spend dollars to best use when there's a million options now for people to stream content versus going to the movies and talking about it on social?
Right. I think definitely continuing to have a mix of everything for channels is important in terms of looking to get the word out on big theatrical movies. Something that might seem a little counterintuitive, which something we've covered recently at Morning Consult, is the still importance of linear TV and that channel in terms of having reach and getting the message out to consumers, not only older consumers that you would assume to be more of a linear TV viewer, but also Gen Zers and millennials, which to some degree can still be found on linear TV. So when evaluating options to advertise on, continuing to have a mix of linear and digital channels is still very important.
So that mix still important there. Thank you so much for that update. Kevin Tran there, Morning Consult Media and Entertainment Analyst. Thank you so much. Right, with inflation still weighing on Americans' wallets, the White House is working to promote the broader economic message. Jared Bernstein, chair of the White House Council of Economic Advisors, joined Shauna Smith and Jared Blickery on our 3 to 5 show yesterday. Here's what he had to say.
He's framing out this idea of Bidenomics, which is building the economy from the middle out and the bottom up. And he's making a stark contrast between that and top-down or trickle-down economics, the failed idea that if you just cut taxes for rich people, that's going to somehow uplift the middle class, against decades of evidence that it just doesn't work that way. How does it work? Well, the 3 pillars of Bidenomics are reinvesting in America, reversing years of disinvestment in our public goods in a way that crowds in hundreds of billions of investment from the private sector, promoting more competition, both to lower costs and to give small businesses a fair shake, and empowering and educating our workforce. Put those together and you have a strong recipe for continuing some of the positive growth that we've seen thus far and continuing to make progress against inflation.
Chair Bernstein, it's great to see you here, Shauna. But what stuck out to me a couple of things stuck out to me in this speech. Well, one thing that did stick out to me was when the president said that he wasn't declaring victory yet. And I bring this up because from your perspective, as one of the top economic advisors to the president, what do you view as the or one of the biggest dangers to the economy, and how are you what's your plan just in terms of how you plan to work to address that?
Well, look, this is an economy, as I'm sure you've had in many discussions, that has some real headwinds. We obviously had some challenges in the banking sector, so important for credit flows. We have a hiking cycle. We have inflation that has come down significantly but needs to come down more. But also, some really important tailwinds. And I think too often people maybe don't get that balance quite right, especially those who look around and say we're in some kind of a recession. I don't think the data support that at all. And in fact, I think if you look at the recessionary indicators, they're all pretty clearly in a non-recessionary place. But if you look at a virtuous cycle between a tight labor market generating wage gains, generating consumer spending, which of course is almost 70% of nominal GDP, it becomes a little bit less of a mystery why we keep having this positive cycle, why we keep having job gain months that beat the forecast, I think 14 or 15 months in a row. So that kind of virtuous cycle is a real tailwind. There's also headwinds, and that's just the way it is right now. We have to, we have to be mindful of both of those forces.
And we heard from Fed Chair Jerome Powell earlier today, once again reiterating that 2 rate hikes could be necessary at this point in order to get inflation under control. You just mentioned the strong jobs market. If we do see 2 more rate hikes and consecutive at that, Powell saying that that's on the table, what do you think that is going to do to the labor market?
Well, I think without getting into any granular critique of Federal Reserve policy, which I think one of the more important things we can continue to do to help inflation ease is make sure the Fed has the independence they need to do what they have to keep doing, what they have to do. I think it's important for us to recognize that Pillar 2, particularly today, Pillar 2 of Bidenomics is making sure we have an empowered and educated workforce. Now, what does that mean? When we talk about worker empowerment, one of the things we're talking about is the tightest job market in decades. Unemployment below 4% for a year and a half. Now that's the overall number, but we know that means particularly low employment for groups that are far too often left behind. And that's something this president is acutely aware of. The importance of tight labor markets, he talked about it today under the rubric of full employment. The importance of tight labor markets to give workers a little bit more bargaining clout. That's also why he's one of the world's most pro-union presidents we've seen. Now, add that to educating our workforce so that we can complement things like our CHIPS program, where we're incentivizing significant investment in that sector, standing up a domestic semiconductor industry, and you're helping to build out the economy's supply side, in this case, labor supply, but also chips and infrastructure. Building out the economy's supply side, its capacity, puts medium and long-term downward pressure on inflation.
Jared, while we have time here, I just wanted to bring up the fact you were recently promoted to the chair of the Council of Economic Advisors. What does the Council of Economic Advisors look like right now, and what kind of transition, if any, has it been undergoing?
Well, what it looks like is a staff of about 30 junior and senior economists who are some of the best economists in the country who come to CEA to help serve this president and his vision of Bidenomics. And we continue to do what we've been doing, which is provide the president and the senior staff with up-to-date analysis information on the data flow, much of the same kind of things you talk about here. Try to look around the corners and see where those headwinds and tailwinds I just talked about are taking us. Of course, every year we write the economic report of the president. And look, at the White House, we're very much involved. The CEA is very much involved in our policy processes as well as we think through how to best implement our investments in clean energy and electric vehicles and semiconductors, making sure that the economy stays on track at the same time that we're building from the bottom up and the middle out, very much in the spirit of Bidenomics.
All right, let's get you a final check of markets at the moment. As we're seeing, they're green across the board here, actually near session highs at the moment for the Dow, the S&P, and the NASDAQ. And so as we can see here, the Dow up about 220 points, the S&P 500 there up about almost 17 points there. Tech-heavy NASDAQ, they're also up ever so slightly, about 17 points there. So certainly around the highs of the day. All right, well, we're going to have a look here at Virgin Galactic. As we've mentioned, they made their way to the edge of space. And so we've been tracking some of that stock movement there. As you can see, they're down about 7.5% there. We'll be keeping an eye on that for you throughout the day. As you're looking at some live pictures here. All right, nice soothing way to end the 11 o'clock show, but we'll be back with you at 11 a.m. Eastern tomorrow. See you then.